Everybody smile. We're live. I see attendees coming into the room. Let's rock and roll. Hi, I'm Todd Phillips. I am your host, RE Journals. I'm in Minneapolis today, and Minneapolis and Milwaukee were two completely flyover states up until a few months ago, and now we're the source of riots and now election conundrums. It'll be super fun to be us Midwesterners. But anyway, we're going to do an event today. I'm going to figure out how to share my screen. We're kind of new to Zoom, so just bear with us for a minute. We switched over from Webinar Jam. We are figuring this out as we go. Let's see, start. Okay, this is us. There we go. Midwest Real Estate News, third annual Milwaukee Commercial Real Estate Virtual Summit. Thanks to our sponsors. This is a great group of sponsors, y'all. It's so nice to have people come with us as we've pivoted from live events to virtual events, and we're going to go back to hybrid events. So I'll be able to come to Milwaukee in the spring, and we'll be able to let you be live or remote as soon as we kind of work our way through this corona. But without sponsors like this, we couldn't do any of it. So Whipley, CBRE, TCF, Davis and Kilthau, I got that right this time, Peak Construction, Reinhardt. I'll move my camera, Franklin, CARW. I don't know, is that CARW? Or is that, you guys go by, I don't know, anyway. Mosaic, Corfac, Berkadia, let's rock and roll. Keep it going. Next page, please, Todd. Thank you. RE Journals, this is us. So we've grown. We've added some publications. We're now in 17 different states. Midwest Real Estate News is stretching across the Midwest. We'll do 150 events like this next year. So that's pretty exciting stuff. We're going to use the chat room. So you should see at the bottom of your screen or on the right-hand side of your screen, a chat room. Click on that and get that up. And that's where you can say hi to each other. You can talk to the panelists. You can ask questions, and we may ask questions of you. But this is our first panel, 2020 Apartment Market Update and Forecast, Opportunities and Unexpected Challenges. Ouch. I'm going to turn this over to our moderator, Tracy Johnson. She's going to introduce these folks. I might bring these slides up one more time just so you have their contact info. But Tracy, I'm going to get out of your way. You ready to roll?
We are ready to rock and roll.
Awesome. Thank you. Good luck. Let me know if you need anything.
Okay. Welcome, everyone. It's a pleasure and honor to be with you today. I hope that you'll enjoy the presentation. I certainly have enjoyed preparing for this presentation. As Todd mentioned, there is a chat function that I invite you to use throughout the panel. Here's what we're going to do, though, when addressing those chat questions is we are going to kind of keep track of those as we go along instead of addressing them bit by bit, and we'll have plenty of time at the end. But please, please, please ask those questions along the way. So instead of me introducing our fine panelists today, I'm going to ask them to all introduce themselves. And so what we're going to start with is name your organization and what you think the biggest factor driving apartment and multifamily market demand is. So let's start to my left, Patrick.
Tracy, thank you. And hello to my esteemed panelists. Great to see everybody again and all of our guests. Coming to you live from my dining room table in Shorewood, Wisconsin. Glad to be here with everybody. Patrick Gallagher, I'm an executive vice president with CBRE, which is the world's largest commercial real estate services firm. I run our capital markets group and specialize in investment property sales. And, you know, right now, obviously, the biggest factor impacting multifamily demand is the COVID pandemic-induced recession. That's a simple answer, I think. And I want to see if anybody else has any other intelligent alternative theories. So pass it back to Tracy. Thank you.
All right, we're going to dig into that. There are so many pieces to that and so many facets to that answer. Let's go to Jason Korb. Unmute. Oh, Jason, there you go.
Sorry about that. Jason Korb, Korb Associates, Architects in Milwaukee. I would guess that a big driver is capital is afraid of the stock market given its volatility and is looking for safer places to place it. And right now it is in multifamily.
Well, and the stock market is going crazy as of right now. So I'm going to want to dig into that a little bit too. Ralph, how about you? Introduce yourself and what you think the biggest driver for multifamily market demand.
Hi, I'm Ralph DePasquale. I'm a managing director for Berkadia. I kind of share my time between Wisconsin and Chicago. We have offices at both locations right now. We're part of Berkshire Hathaway, essentially Warren Buffett's commercial mortgage group. I'm on the investment sales side and run essentially the Chicago and Milwaukee operations for that. What is the most important? I think just adding on to what Patrick had said, it is obviously more immediate is the COVID, but essentially it's jobs, and jobs are always the key factor in the apartment business. Where there's jobs, there's usually apartment development and or better occupancies, things like that. So where the jobs go usually where the apartments go, and in terms of the market. And we'll delve into that too, I'm sure, some more as well. But
well, and all of these things seem so interrelated. So let's move on. SR Mills. Introduce yourself.
Thanks, Tracy. SR Mills, Repair Real Estate Group. We're a vertically integrated development construction firm based in Kenosha, Wisconsin. We're active in throughout the Midwest and Southeast. Good question is related to what's impacting the multifamily market. I guess specific to the demand side, I was thinking about it as much even specific to the supply side, where one thing we're seeing right now is a lack of inventory at really all housing levels. So from the starter home to the next home above that, and it creates a bit of a backlog where if we can't move somebody out of a $200,000, $250,000 house up to a $350,000, we never end up making that spot available. And I think that constricts some of that supply and really makes it difficult and creates a lot of demand. So there's some benefits and negatives to it.
Great. Well, lots of different places to go with this. Thank you for those introductory remarks. I should introduce myself. My name is Tracy Johnson. I'm the president and CEO for the Commercial Association of Realtors Wisconsin, or as Todd affectionately calls it, CARW, C-A-R-W. We work with all of those involved in the real estate space throughout the state of Wisconsin, Illinois, and also some members in Minneapolis. So let's move to something else that's a little more timely as well, having to do with COVID, the stock market. This is all interrelated. Do you see any of the results of our election or any future tax policy that could come about in 2021 as impacting this market? Let's start with Jason.
So what we've seen is that everything is sort of slowed down due to uncertainty between the political situation and COVID, with the exception of multifamily and the exception of industrial and distribution facilities. So those are sectors in the real estate market that just continue to appear to have strong demand. I don't know if you wanted to be more specific on that question, Tracy.
No, I think that really covers it, in terms of the uncertainty, and what we like in real estate is that certainty. What's really interesting though about with apartments and industrial and how that's all interconnected is, that so much of this has been planned, or so much of this has already been established pre-COVID. Ralph, what are you seeing in terms of any future impacts, especially as you kind of straddle that line between Wisconsin and Illinois?
Well, I mean, in terms of policy and the election, and obviously there's some pretty divergent opinions on what's going to happen in terms of policy going forward. I think some of the bigger things that might affect our market, especially from an investment side, is long-term capital gains treatment, and there's been talk back and forth on either eliminating or somehow changing the 1031 exchange rules, which would have a huge impact on the overall market, at least in the short term. Obviously, everything adjusts eventually, but that might cause people to either rethink the timing on dispositions if something does go through, or maybe if there's a window of time where something like that is enacted, that certainly could have an impact. And then just general taxes obviously are the biggest impact from both investments and development, and that sort of interest rates. Obviously, in the interest rate environment right now is almost unheard of. I mean, it's essentially almost free money, and that's not going to last forever either, and it can't. And so that's another factor, obviously, that's going to impact everything from investment sale pricing to development to everything else in between.
We don't see, or I shouldn't say we don't, but do you see any indication of when we might see a change in those interest rates? Because that low interest rate environment, we've been talking about that for a very long time.
June 25th of 2021, they'll go up. No, I'm just joking. I'm joking. I'm making a bold prediction.
Ralph, you got it wrong. It's the 26th.
I'm sorry. I'm always a little bit behind. No, obviously, if we knew the answer to that question, that would be great. We'd be able to share that. But we don't see in the short term, and when I say short term, probably over the next year, rates moving a tremendous amount. But I spent probably 3 or 4 years saying this is the year that the rates are going to, go up, and they never do, and they never did. I think it's all going to be a function of the economy, and I think especially with us coming out of the COVID situation and the economy getting sort of back on its feet, we don't see interest rates probably moving very much in the next year. And when I say that, we've all gotten spoiled with rates being at 3% or 3.25%. And not many of us even maybe remember when rates were, a good rate was like 6.5% or 7%. And so anyway, we don't see anything in the short term.
Very good. SR, I kind of want to pivot this question a little bit in terms of you do a lot of work in the Kenosha, Racine, southeastern Wisconsin market. Can you speak to maybe some of what you're seeing in terms of how it's affected by the jobs that are created? Just kind of give us a little flavor of what that looks like.
Sure. I mean, I think as we think about the supply and demand side of it, the demand side is directly impacted by what kind of jobs, what kind of job centers. And down in this area, Foxconn hasn't brought the impact that we originally thought it was going to bring, but there's still lots of good things happening in Haribo. A lot of folks from Illinois, we're still being able to coerce them to come north of the border here. And we're seeing that fill our industrial parks, distribution, warehouses has been a massive influx. And what that's done is that is really pushed the need for housing in all sectors and in all types, from workforce housing up to high-end estate single family lots. So we're continuing to see that big impact, and a good 30 to 40% of those buyers are typically, or renters are typically have Illinois plates on their car.
Great. Just building on that a little bit more, obviously when the news of Foxconn and some of the other development came to southeastern Wisconsin, there was a mad rush to really, build hospitals and infrastructure, obviously create more housing. And even if those jobs per Foxconn aren't coming to fruition, are you still seeing that huge interest? So in other words, you're maybe getting a little bit ahead of what that demand might be in terms of industrial or manufacturing development?
We always try to stay a little bit ahead of it instead of the alternative of being behind it. But with that said, we in our firm, we don't do a lot of industrial. We do some, but we've certainly seen it on the housing side, where we have a handful of different developments we're working on in and around the Mount Pleasant, Caledonia, Union Grove area, Burlington, and I mean, the good thing is we weren't completely, I don't think anybody in the industry was completely betting on that being this massive success. We were betting on it having an impact, but as such, there's a lot of other great businesses too that are growing in the area. So the impact is happening through a variety of different companies. So it's made a big difference.
Great. Patrick, if I could move to you and just maybe if you could give a bit of an overview on the state of Milwaukee's multifamily marketplace in terms of investment and development, what you're seeing.
Well, that's a really big question. Thank you. I want to touch on the election really quickly and just say that under both types of Republican and Democratic administrations, commercial real estate has performed about equally well under blue or red, going back to 1978. And I'll be real high tech here and just show you a little graph here. And there's blue and red going back to 1978. And you can see that it's pretty equal. So I don't think this election is going to really meaningfully change how investors are going to behave, how renters are going to behave. And basically, Milwaukee's doing really well. When you look at nationally, a lot of the major metro areas, particularly the urban areas, are getting pretty decimated due to this COVID pandemic. There's a loss of jobs, reduced income, loss of confidence in future income. In fact, there are more 18 to 29-year-olds living at home now than any time in the past since the Great Recession, the Great Depression. So demographically, there's a lot going on that I think Milwaukee is going to benefit from. So what's happening is urban areas in downtown San Francisco and New York City and Chicago and a lot of these major metro areas, people are flying to the suburbs and flying to tier 2 or tier 3 cities from the tier 1 cities. Basically, if you can work from home or work from anywhere, you can live wherever you want. And because of the limited availability of entertainment and other urban amenities, people are sort of fleeing the dense CBDs in lieu of suburbs. Additionally, people are uncomfortable taking public transit. These are all COVID related. More living space is desired as renters spend more time at home. And many renters desire better access to outdoor options as an outlet for long hours in the apartment. So those are all COVID related. And then secularly, the cost benefit calculus of living in a high rise, high rent district versus, a lower rent suburban area is starting to come into play. And really, millennials are moving to the life stages where urban living is often traded for less dense housing options in other submarkets. And so I think nationally that's happening, but I look at Milwaukee, which is technically categorized as a tier 3 city, as benefiting from this trend. Certainly we're going to see some people moving from downtown Milwaukee to the suburbs for those various reasons. But I also think that Milwaukee is the kind of city where people will move to from downtown Chicago or New York City. As an anecdote, one of our colleagues in Kansas City, they were analyzing a multifamily property they were about to launch for sale. And the absorption, when they were looking at the absorption, 10 of the units out of 200 in the month of, I think it was May, were leased to renters moving from New York City to Kansas City. And it's just astonishing when you look at those long-term trends of people moving from really high, dense urban areas to suburban areas and maybe even places like Milwaukee and Madison, Kenosha. I think it's going to be a really great, it's going to be a great trend for Wisconsin in general. And so I'm still very bullish on Milwaukee, and I'll let somebody else take it from there.
No, that's great. And it in our prep, Jason, you had talked about some of the trends that you're seeing in terms of, from an operations standpoint or from a design standpoint, whether it's suburban or downtown. Can you speak to that a little bit? Are you seeing the high rise developments, or are you seeing more mid-level community developments? Can you speak to that a little bit?
We talked in the prep about how what we're seeing in multifamily in particular is sort of barbell development, which is it's either affordable or extremely expensive, and there's a missing middle. And SR could probably follow up on this, but it's, the 80 to 100% of AMI renter. There's no new building that really can hit them because the low-income housing tax credits projects are capped at generally 60% of AMI, and the luxury offerings are, generally starting at 120%. Okay, and so our clients have been trying to figure this out for years, and I think we're getting close, but it's really that there's really a hole in the market. But both the luxury market and the affordable, well, there's endless demand for affordable housing, but even the luxury market, we don't think we've hit it yet. We have a 260 unit building coming out of the ground right now. It won't even be done for 2 years, and it's already 5% reserved. So demand seems to be really strong, but there is a hole in the multifamily space that people are still trying to figure out how to fill.
And I'm going to move to SR in just 1 minute, but I want to add on to, from a design standpoint, what are you seeing, whether it's more bedrooms to accommodate, maybe somebody who can't get into a house because of that restricted supply, or is it more of the 2-story development?
Sure. What we're seeing in our multifamily work, we're seeing again almost barbell development there. So there's a trend towards units that are really small and efficient, and then the buildings need to be highly amenitized. So our clients are always looking for amenities they can offer that differentiate themselves in the market. But on the other hand, we're seeing projects where the units are actually very large and are sort of being built to replace people who are downsizing out of single family homes because they just don't want to deal with the maintenance anymore. So again, we're seeing both in finance and in design, we're seeing this sort of barbell development.
Great. And I think that's a perfect segue to SR as we talk about your work in affordable housing, maybe addressing that middle of the barbell, what's being done, and maybe even speaking to how demographics are playing into that, if it's a factor. Oh, mute.
If I had a nickel for every time I left mute on. As Jason mentioned, there's a significant gap, and it's not an easy gap to fill. I mean, he's talking about the person that doesn't want to or doesn't have the down payment to buy a home. He or she makes over 30,000 and less than 60,000, and it's how you bridge that gap. And the federal government's done a pretty good job of stepping in and in conjunction with HUD and trying to adjust some of the policies. One of the things specific to the affordable housing industry that's been really important is income averaging. And income averaging is giving us the ability specifically on 4% tax credit deals to in turn take what in the past we used to always have to try and hit the mark. If we were, on average, you needed to be at that 60% area median income. Well, it behooved us to be right at that 60% because we couldn't lease it to anybody higher than that. And for every dollar less than that, it was a dollar less that could go towards the mortgage or debt service and being able to, or cash flow and create a nice product. Well, the HUD in federal government came around, they decided, well, let's do something called income averaging now. So you don't have to hit this very narrow band of everybody that is right at that 60% area median income, but no higher, because, again, there's 2 factors. One, you can't be higher than the 60%, but 2, you have to be able to afford the rent. So, it really narrowed the slice of who we were providing workforce housing to. But then by doing the income averaging, we can now go up to 80%. So now we can have a striation of 80, 70, 60, 50, 40. And it opened up our markets tenfold because we can now hit the same gross income level and cater to that many more people that frankly just didn't have an option prior. So if you were at that 80% AMI level, there was really very limited affordable housing open to you through any kind of specific program, at least. So now with this, what we've seen is, as Jason mentioned, is we have waiting lists of 200 people for brand new developments that we've just opened up. So it's been pretty staggering. The need is insatiable and it's significant and it's not going anywhere, but we think income averaging was a good tool to try and broaden the breadth of these programs to make sure they work for everybody in today's day and market.
So, and this is a question for whoever has the data and the information. It just struck me from the standpoint of, what's really happening in the market right now. How many units are right now under construction across the board? And where are those hot pockets as we talk about, we're seeing Kenosha. I know, Patrick, you do a lot of work in Madison. What are we seeing? And are there any challenges outside of financing, like construction costs or availability of labor to get those projects done?
Lots of challenges.
That's a whole other webinar, right?
Yeah, it could go a variety of different ways on that one. I'll start off and let the rest of the guys finish it. But I mean, one of the things that we're seeing is construction costs. I think it's every year we'll comment about how costs are going up, but lumber this year is tripled. So we've had to get real creative where we're buying futures, we're hedges. Suddenly we're in the options market, and it's not a pleasant spot that we really wanted to be in, but we build about 1,000 multifamily units a year, and we had to figure something out because we were so susceptible to those swings. It seems that it's going to start leveling off a little bit with some of the mills opening back up, and but it's going to take a while because a lot of the lumber yards have really expensive products sitting on their yard, and they don't want to take a bath on it. So,
Well, to confound those high costs are these flat rental rates that we're seeing. And, Milwaukee's traditionally had about a 1.9 to 2% rent growth historically over the last 15 years. I would say that's closer to 2.5 or 3 in the Milwaukee area. Madison for sure is a little higher. But now rents are really flat, which actually is good news in Wisconsin compared to most of the rest of the nation. Again, these some of these Midwestern tier 2 and 3 markets seem to be holding up really well in terms of rent growth compared to much of the rest of the country. Nonetheless, when you project flat rent growth for a year and you're struggling to make that formula between your market rental rates and construction costs work, it doesn't help to have flat rent growth and construction costs go up. So, that's just another layer of difficulty that developers are facing now.
And I was going to say, I think that, not only flat rent, I think overall flat rents, if you look at, it's almost as you were alluding to earlier, Patrick, it's a little bit different when you're looking at downtown versus suburban. And that's really across the board in a lot of markets, but, Milwaukee's really no exception. I think most of the suburban markets, suburban Milwaukee areas are doing better than downtown right now in terms of concessions and when you start looking at really effective rents versus, what's asking rents are. And so we've seen a fair amount of development. And the nice thing over the last, 5-10 years, let's say, is that Milwaukee's been able to absorb a lot of it just because of job growth or, people moving back downtown, let's say, or whatever it might be. When you take that equation away, but you still have units being delivered, obviously in the short term, there's going to be a little bit of pain. And I think that's what we're seeing in the downtown market right now. Again, on the short-term basis, a little bit higher concessions, flatter rents, which effectively means lower effective rents, where you're not seeing that quite as much in the suburban areas. And that's true of Madison as well.
Did you see any immediate uncertainty with the notion that renters may or may not be able to pay rent? I know that I've heard that rent collection has actually been very good throughout a lot of these shutdowns. So how did that impact your ability to secure financing or continue on with your developments, or even just even broadly to operate your investment?
Well, I think in general, if you look back, it seems like a whole lifetime ago that it was spring, but it wasn't that long ago. And when COVID sort of started rearing its ugly head, I think that was probably one of the biggest things that people were wondering is, as people lose their jobs or we saw unemployment skyrocket for a little while, are people going to still be able to pay their rent? And in turn, are borrowers still going to be able to pay their mortgages essentially on these apartment complexes, or are they going to be looking at forbearance on some of these? And so that was really the big focus. If you look at really April into May of this past year, how are the rent collections going to be? And I think the stimulus packages that were put in place really helped that situation. I think there was a real panic there for a while. I think it's alleviated somewhat as the months have gone by and people still have had generally strong collections. I think it's interesting that the Midwest in general, Milwaukee included, Chicago, if you look at a lot of the Midwest cities, have had stronger collections for the most part than some of the other parts of the country. San Francisco's, for example, or some of the East Coast cities, and so that was a big fear. One of the things that lenders did in response, because there's still a great push, obviously, to either acquire multifamily. It seemed like we took there was a lull for about 3 or 4 weeks, it seemed, and all of a sudden, the market sort of ramped back up, and we're at pre-COVID levels. I mean, in terms of pricing and things like that right now, mostly due to the interest rates and kind of pent up demand as well. But one of the things that lenders did is they started putting in reserves. You're borrowing money. We're going to take, initially it was as much as 18 months. Now it's really down to about 9 months, let's say, of interest and principal reserve up front. So that was adding to the equity required to do a deal. I think slowly but surely that's starting to go away a little bit. It'll be interesting to see, with stimulus and how that's all affected over the next few months, how that will play out. But that was certainly a factor. Doesn't seem like it's as big of a factor now, but time will tell over the next few months.
Certainly, and obviously that's tied to unemployment numbers and
correct
jobs that are being.
I was just going to echo Ralph's sentiment. I think there's still a pretty big risk that collections are going to increase. The first stimulus burned off. We haven't seen a second stimulus package, which is going to help those people that are furloughed, or what we're seeing is more permanent job losses now, which is really concerning. And so as the unemployment stays high and jobs are scarce and shrinking, that's going to mean bad things for collections, particularly if we don't get a second stimulus package to really help bridge the gap between now and when some of those jobs do come back.
Mm-hmm.
Echoing that, I think it was in last Wednesday's Wall Street Journal, they said that right now the Federal Reserve estimates that it'll be about $7.2 billion in rent owed from residential rent. But Moody's made some predictions that if a second stimulus package isn't made and the deal isn't cut here the next 30 days, it's going to go to $70 billion by the end of the year. So, I think they're saying 12.8 million people. An estimate is there's going to be the average rent burden is $5,400 a head. So it's pretty darn significant. I think it plays off the fact that we're seeing decreased jobs and the rent staying the same. So it's going to put some real pressure on the industry. And as we talk about the politics side of it and what's important, that stimulus package is really important. So that will be a direct impact of whomever's voted into office.
Yeah, I thought it was really impressive looking at those numbers, not only on the apartment rent collections, and obviously we've got eviction moratorium, which was probably more important in some of those larger cities. But the way that stimulus really trickles down, that is a big jump. That is a big number, SR. I had not heard that. That's a lot. So when we talk about that rent growth, though, I mean, because that was kind of one of the areas we wanted to go into. How are we going to see that turn around? What are the things that are going to need to happen? Because you're continuing to put supply into the market. You continue to have all of these economic challenges. How do we ensure that rent growth going forward? And maybe that's tied to some of the challenges and opportunities.
That's a great question. I think it's a combination of things. First of all, supply is slowing down. There is less construction, this year. There will be less construction next year. There's just supply. There's going to be some supply constraints because of this pandemic for the reasons we've talked about. And then on the other side is the demand drivers, our jobs. We really have to make sure that we're creating good jobs, and we have done so. And if you look at downtown Milwaukee, Michaels Corporation moving downtown, Komatsu Dresser building a massive research facility on the south side of Milwaukee, Rexnord moving 500 people to downtown Milwaukee, American Family moving downtown. Now, some of those are transplanted jobs, but then there's Milwaukee Electric Tool, which is opening a 1 million square foot R&D facility in Menominee Falls at Good Hope and Appleton Avenue. And they're going to employ 770 people. Those are really good demand drivers, and that's what we need to keep fueling the fire, so to speak. And I just want to address, there was a chat question on the fires, and is this trend towards these tier 2 and tier 3 cities sustainable? And I think it is, in part because, I have friends who are moving back they moved from Wisconsin to California. Now they're moving back again because they're tired of droughts and mudslides and wildfires. And the Midwest is really a safe haven for a lot of these natural disasters, particularly as the effects of climate change continue to accelerate. So I think, I think we're in a really good place, and I just wanted to address those chat questions.
Yeah, well, and it's interesting too that you're talking about all those large companies creating all the jobs. I mean, that is certainly a bright spot to talk about, but really, and it was brought up by a couple of you throughout the presentation, public policy and mobility are two of those huge drivers for stickiness and keeping people in those homes. You look at a San Francisco, you look at a New York City, where people they're saying work from home, and people don't want to work in their tiny little studio apartments, and so they're leaving. And now you've got these corporations that come back and say, well, if you leave, we're going to pay you less. And they're doing kind of some of this geography-based pay. And so when we talk about a Milwaukee Tool, or you talk about a Rexnord, the fact that we're able to keep our economy open and we're keeping it open safely and continuing to move on, I think that's going to speak volumes moving forward. And to your point, Patrick, it's going to play into the long-term attractiveness of our region and our state. Does anyone else have any comments on some of those drivers and the challenges?
I think it's important to note the job growth that is going on, as Patrick alluded to just a few minutes ago. And SR, I think some of those numbers, while they're very true, they seem to be more coastal, in terms of not. I don't want to say the Midwest isn't affected. It certainly is. Of course it is. But we seem to be doing a little bit better resiliency-wise than some of the other parts of the country, especially when you look at, a San Francisco that, where you're paying $5-6 a foot rents for a studio apartment downtown, and which is now vacant completely, or people aren't paying that rent. We've had a lot better success, or much better success in collections. I think in Milwaukee right now, I think we do a thing called a rent payment tracker. I think we're at 91.8% collections overall, which in some parts of the country that's down to as low as high 70s to low 80s percent wise. So. Some of those drivers, I think the Midwest has a little bit better resiliency, and I think that's attracting, from an investment standpoint, people to the secondary and tertiary cities and markets just that are a little bit more stable.
And I echo that too, just to follow that up. Our default rate during COVID, we were very concerned about it. We're preemptive to go cut deals with our tenant base, both on the commercial, but really on the residential side. And I think at one point we had a max of 3% of folks, 3 to 4% of the people where there was some kind of deal cut where we had a payment plan. Most didn't take us up on it, quite honestly, because of the stimulus, and they were able to work through it. Right now, we have less than 1% outstanding rent. So it's been pretty phenomenal, but the concern is we just don't know how big of an impact. The state of Wisconsin helped many low-income, moderate income folks with assistance, and then just the stimulus in general. We're hopeful it doesn't have as big of an impact, but we really don't know because we haven't been in a period where that hasn't existed, and we've been in the same situation.
There's a lot of you. We're talking about Milwaukee a lot, and I want to make sure that stays in the spotlight, or at least southeastern Wisconsin. But a lot of you do work nationally. Can you maybe speak to that a little bit, and how maybe there are some other best practices that we can see, whether it's in terms of the relationship with the municipalities, whether it's the connection to the business community? What are you seeing out there in terms of other places that are really hot right now? I know, Jason, you're doing some work across the country.
Well, we're doing some work in the Southeast right now, and what we've generally found is that, and this is generally at the municipal level, that municipalities and economic development folks are extremely pro-development. And I won't gripe about Milwaukee too much because it's generally a really good place to work compared to other municipalities. Instead of throwing roadblocks up, their immediate reaction to hearing about a project is, how can we help? And they tend to put their money where their mouth is, in the form of incentive. And I think we see it. And again, Milwaukee is pretty good about that. It's a good municipality to work in. But I generally have had really good experiences. And again, we're kind of focused in the Southeast right now. And that's been our experience down there. I know SR is in that part of the country as well. I don't know if that's been your experience.
It has, yeah. And every municipality we found can be different, and there's different nuances. But the idea of trying to align goals, and as long as goals align between municipality, development, citizen stakeholders, had pretty good luck. Right now we're in, I think Tracy and I talked about it, doing a project in Huntsville, Alabama. We've done some work in Georgia, Florida. The markets are hot. I mean, when you look at population growth, it's the Southeast is where we see it. So it's, but in comparison, we're also, right now we have a large project in Jackson Hole, Wyoming. It's a different kind of product, but one of the chat questions was about the influx of tier 1 renters. In Wyoming, people are leaving California and New York for different reasons. Some of it's tax, but much of it's lifestyle. And I can tell you that those people that are leaving are gone for good, and that's their objective. So I think it is I don't think it's a trend. I think it's a shift in demographics that we're going to see. And Southeast is no different. There's a reason their populations are getting larger and larger.
Our biggest growth area is Northwest Arkansas, to that point, because of Walmart, because of Tyson Foods. It's a huge distribution hub, and the housing follows that. But to circle back to Wisconsin a little bit, I do want to mention that these what they're calling tertiary markets have been incredibly supportive of development. So we've done work in Racine, Kenosha, Sheboygan. They've all been very helpful as municipalities, and the projects have been surprisingly, in my mind, successful. So there's real demand there, because nothing has happened. We did the first Class A building in Sheboygan in 40 years probably, and it was successful beyond, not through anything that we did, but it was successful beyond my sort of wildest imagination. And we're seeing that in Kenosha as well, and hopefully soon in Racine.
I just want to remind the audience that 20 years ago or less, many municipalities would highly resist any kind of apartments, any kind of rental product. It was just astonishing. The tier 3, the really small communities would welcome it just because they want any type of investment. But now it seems like every community is open arms, build your apartments here. We want to have good housing to support the jobs that we're trying to attract. So it's a 180-degree shift, and it probably goes back 15 years, if that. So it's come a long way. And I would say I haven't seen a municipality where it's really difficult. Even some, more affluent suburban communities that have always had a really bad reputation for kind of stiff-arming developers and multifamily are welcoming it. And I'll, at the risk of insulting anybody, I would say Brookfield and Mequon are too, where you see, it was very hard to get anything approved there. Mequon's seen a ton of multifamily development. It's just great for the community.
I think a lot of that too, Patrick, has to do with, you say 15, 20 years ago, which is absolutely true. I mean, you couldn't, finding a piece of zoned land that was ready to go was like gold, and today it's pretty readily available. I think because municipalities back in the day thought, okay, well, you're going to put in, affordable housing or Section 8 housing or whatever, very low grade housing that's going to go in this location. And I think what people have come to realize that in many cases, the stuff that's being built is sometimes nicer than the single family homes that are being built. And the rents that are being paid are even more than whatever the mortgages and taxes are on those. And so I think that's been one of the biggest drivers of people staying in Milwaukee or coming to Milwaukee, is that 15, 20 years ago, it was a pretty bread and butter stock of apartments, in the area. There wasn't very much in the way of bells and whistles and things happening downtown, and to attract that graduate from UW in engineering, whatever, they would get their degree and go someplace else in the country. And I had a niece that actually graduated a couple of years ago that had options to go different places and really liked downtown Milwaukee, ended up working for Kohl's for a couple of years, coming out of UW. And so I think that's part and parcel of why there's been such activity downtown, and the housing stock has improved tremendously from what it was 10, 15, 20 years ago, for sure.
Well, and it's interesting. We talked in the very beginning about home ownership, and that the American dream, right? You want to buy a house, but with so many things happening on the demographic side, not only our young people kind of staying in cities longer and kind of delaying that choice, it's really creating those opportunities for an upgraded apartment lifestyle, whether it's in the suburbs or whether it's an upper end apartment in the city. And of course, right now, that's being fueled by the lack of supply on the housing side. So anyone else have to comment on that? And then I want to move to we have about 10 minutes left, and I want to remind everyone that if you have questions, to add them in the chat function, really shifting to looking at the future for Milwaukee area multifamily development and investing. And I want to go around the horn and get everyone's perspective. And you can even set up scenarios. We're going to have all this rent growth, or we're going to have, new headquarters. What do you see in the future? And let's start with Patrick.
Sure. Well, I love Milwaukee. I love the Midwest. I think Wisconsin's got great things in store. One of the things we don't do is we don't overbuild. We don't overinvest. We don't have the peaks and valleys that you have in some of the other major metros. So, the downs aren't so low and the highs aren't so high, and that's just fine. It creates good predictability. And if you're a developer or an investor, I think that's a good thing. Again, I'm really bullish on the Midwest, and I love Milwaukee. I love Madison, southeastern Wisconsin. I think there's good job growth. There's good employers trying to make things happen. And I will say it's a great place for investors to come because there's still a slight return premium for investing in Wisconsin compared to other apartment projects in certainly the coasts, the major metro areas, and even our peer cities like Minneapolis and Indianapolis are seeing cap rates as low as 4%, and we're not quite there in Milwaukee or Wisconsin in general. So I think there's an opportunity for investors to come here and buy good quality assets, lock in long-term, low interest rate loans at 3% or lower. And if you can buy a property for a 4.5 or a 5 cap in Wisconsin and put a 2 3/4% loan on it for 10 years, you're going to be good for 10 years and beyond. And so I think the same thing for developers. If you can find and execute on really smart, thoughtful, well-designed product in good locations where there's slow but steady job growth, I think you're not gonna lose, and you're gonna win long term for sure.
Great insights. Ralph, let's go to you.
Well, I guess I'll echo a lot of what Patrick just said. We're doing a fair amount of business right now in Madison and Milwaukee, and Madison has just been a tremendous market, and Milwaukee has too. Obviously, very low volume for the most part in terms of investment sales. So there's quite a bit of demand right now, especially with rates the way they are, as Patrick alluded to. I mean, you could buy a fairly aggressive cap rate, or at least what we would have thought would have been a very aggressive cap rate a few years ago, and you're looking at almost sometimes double-digit cash-on-cash returns because of where the rates are for the next 10 years. So, and true on the development side too. I go back to what I talked about earlier, and that's jobs and job growth, and Patrick is right. I mean, generally Milwaukee doesn't overbuild very much. Occasionally a little bit, but not much, and been able to absorb things. And I think especially stuff along the southern, between Chicago and Milwaukee, north of the state line, obviously, I think that area is just going to continue to attract new companies and thereby new jobs, and thereby more supply, more apartments, I think, for sure. Somewhat to the west and northwest, I think, as well. And I think downtown Milwaukee, with everything that's going on down there right now with the arena and just the great vibe that was going on there before COVID happened, I think will come back. I think hopefully this is just a temporary blip, and it's just got too much to offer for it not to be, it's probably never going to be a tier 1 city in terms of population and things like that. But, in my estimation, it's got the same things going that a lot of these major cities have now.
Great.
We don't want it to be a tier 1 city, Ralph. We don't.
I don't either. Believe me, I know. I want to keep it, but yeah, absolutely.
Great. Jason, let's go to you, and then we'll finish up on SR.
So we'll circle back to downtown Milwaukee. I was musing with one of my clients yesterday about, Chicago, for instance, the city of Chicago is about 4.5 times the size of the city of Milwaukee. If you think about the number of Class A apartment buildings, including high rises that have been built in downtown Chicago, it's probably 100 buildings, and in Milwaukee it's 1 or 2. So we were wondering out loud, are we underbuilding? As Ralph mentioned, that's one question. The second question is, where, to Patrick's point, where's the money coming from? Our biggest projects in downtown Milwaukee, the money is coming from not Milwaukee. Some of it's actually coming internationally, which is interesting, and some is coming from other states, basically, and huge investors. So the institutional money, which I think others could speak better than I, but the institutional money that used to ignore Wisconsin is now looking here. So that's encouraging.
That's great. And SR, if you could just, finish up and talk through what the future looks like for multifamily development or investment, and maybe highlight some of those opportunities.
Yeah, I appreciate everybody's comments. I think to Ralph's and Patrick's, talking about the debt side of it. I don't think there's too many developers that would own up to the fact that we put 2.5%, 35-year amortization, 90% LTV in our pro formas 4 or 5 years ago for takeout debt. So it certainly cures a lot of mistakes when it looks the way it does now. You can have a few hiccups on the revenue side if you can lock in debt like that. It's certainly not going to stay. When is it going to change? As Ralph mentioned, the market's made a liar out of them every year. As he keeps saying rates are going to go up and they keep going down. That's happened to all of us, and we don't expect to. I don't know when that's going to change, but so I think it's going to be here for a short while. But you sure don't want to get caught if it goes the other way, and you've been betting on it being a lot lower. Bad things could happen. But I think when we think about trends too, we're a big believer in a combination of workforce and market rate. We think it makes better communities. The idea of having, whether it's 50-50, 2/3, 1/3, it allows us to tap into some federal and state resources. In addition to TIF, we know that tax incremental financing is really the only tool in the toolbox, specifically in Wisconsin, for municipalities to help. So trying to offset some of that with whether it's federal tax credits, state tax credits, other programs that are out there to take that burden just off of cities too, but find more creative solutions. Bringing the workforce piece in typically does that. And I think, as it was mentioned, renter used to be a 4-letter word. That's changed. And even, the workforce idea is slowly changing when we put it in context of, who are we really talking about here? So it's become less scary. We found that there's more appetite to having mixed income developments, and that's a trend that we think will be here to stay.
Great. So I'm going to ask one final question. I didn't give you time to prepare, but you mentioned a 4-letter word. We're not going to go there, but one word to describe the future. So you gave us kind of the long answer. We're going to try to wrap it up here. One word to describe the future for investment in multifamily in Wisconsin.
Optimistic.
I like it. Ralph, how about you?
Attractive.
Patrick.
Promising.
Jason.
Cautiously optimistic.
Oh, that was 2 words.
Sorry.
Hey, guys, that sounds pretty good to me. I feel like this is a very forward-looking group. Just quick 5 takeaways as we kind of wrap this up. Just overarching, I feel like everybody here is bullish on this market, and what a fantastic panel, you guys. It was such an honor to kind of work with you today. First, great stability for investment regionally and internationally in our Milwaukee market. 2, limited supply, so we've got great opportunity. 3, the jobs that are really driving that opportunity. 4, we're getting creative in overcoming those challenges. We talked about lots of things today. And then 5th and finally, we have a resilient downtown and a vibrant suburban market. And I think this is fantastic insights. Thank you, all of you on the panel. Thank you for your great questions. And a pleasure being with you today. So with that, I'm going to turn it over to Todd. You're on mute, dude. You're on mute.
Oh,
Thank you, Tracy. And thank you, Tracy, by the way.
how is it the host puts himself on mute? What am I doing? Thank you, Tracy from CARW. Hopefully that I'll get that right next time. I'm going to get just a quick screen up here. So hold with me, folks. I'm kind of new to Zoom and I'm almost 50. So just give me a break. There we go. I think we got that up there. Go, slide. There we are. All right. So we're bringing in a new panel. So if you're on the new panel, unmute yourself and bring in your camera. And I made a mea culpa. All of you were named Alyssa Galinsky. She's one of our fantastic event planners in Chicago, but you're not named Alyssa Galinsky. So I changed your name to please change your name. But once you start talking, I'll fix that. So we'll get there with you all. Okay, everybody's coming in. We got a great moderator this time. I want to get just your, there we go. You all have the patience of saints. Please hold. It will not bring up the screen I wanted to bring up. A week from now, I'm going to have Zoom down. Okay. Well, great. We got everybody here. Hi, Mike. How are you? And I've got to please change your name. Anthony, you found your how to change your name. Zach, too.
Yep.
And there we go. I will get yours, Danielle. Anthony, you are going to be our host and our moderator. Fantastic. Does anybody have any slideshows?
I'm slideless.
Okay, I'm going to bow out, let you take over. I'll update your names. If you need me, just say, hey, Todd, I need something. I'll still be here. I'm paying attention, but you just won't be able to see me. So thank you all. Let's go panel 2. And I believe we're talking Milwaukee market update, industrial, office, retail, opportunity zones, and investment. Take it away.
So first, I want to thanks for inviting me to be the chair of the panel, and I want to thank the rest of the panel right here. So thank you so much for being here with us today. Our topic is really a catch-all. So I think we could talk about anything that we want to talk about that we think is interesting going on in this marketplace today, and that we think the audience would be interested also. So I thought, it would be good to kind of start off with something. Oh, I forgot something really important. Maybe we should do some introductions. So why don't we start with that? So Mike, why don't you introduce yourself? So I'll just let you kind of introduce Mike Van Summeren from Davison, and I'm really bad at your first. Cool. Say it for me, Mike.
Kilthau.
I was going to be wrong, so thanks for doing that. So Mike, why don't you
problem.
Give us just a few sentences, let people know who you are and kind of where you sit in the industry.
Sure. My name is Mike Van Summeren. I'm a shareholder in Davis & Kilthau's corporate team and real estate teams, primarily handling acquisitions, dispositions, leasing, financing, and capital formation.
Great, Mike. Thanks a lot. And then why don't we move on to Danielle Lewis from Wipfli. Danielle?
Yeah, good morning, everyone. I'm Danielle Lewis. I'm a senior tax manager at Wipfli. Wipfli is a top 20 CPA firm, and traditionally we go to market by industry. So I work in our real estate group, and I'm our leader for opportunity zones nationally.
Yeah, I think Danielle is well known giving various talks about opportunity zones. So we're looking forward to your expertise. My photo's up there, so I guess I should introduce myself. I'm Anthony Pennington Cross. With a long hyphenated name, and that photo looks like it's about 10 years ago. So I've aged a little bit, especially over COVID. I'm the Bell Chair professor here at Marquette University. So I focus on real estate issues and teach and do research on mostly in the mortgage finance and commercial property realm. So next, how about Stu Weingartz of Oneguard? You're up next.
Thanks, Anthony. Hello, everyone. I'm Stu Weingartz, CEO of Oneguard Partners. Our company was started in 1992, and there are close to 60 team members who manage about 3 million square feet of commercial properties and over 1,000 multifamily units. This year, we hope to, well, not hope, we are doing over $100 million in new development. And our team members have received many accolades, including Developer of the Year for 4 times. Personal information, my wife and I live on a farm just south of Oconomowoc. I serve on the NAIOP National Board of Directors, also served on the Tax and Finance Committee. Danielle, I'm going to tell everybody, nobody looked to me for tax advice. Danielle's the right person. I'm also on the Mixed Use Forum. I'm a legacy member there, and as National Board of Directors member, sometimes I assist in setting up some of the new chapters with people that are local. Also serve on the Thrive board, which is Jefferson and Dodge County's economic development agency. And then just recently joined the Grass Camp board at the University of Wisconsin-Madison. Go Buckies.
You know, I work at Marquette, don't you?
Well, it's the other great real estate school in the state of Wisconsin.
Well, I believe we have a member from your company, right? Mike Testa has
Yes.
recently joined our board.
Yeah.
So we're happy to have Oneguard represented at Marquette also. So thanks for allowing Mike to do that. It's well appreciated. So I want to hand off to Zach Noble from Dickman Real Estate. Go ahead, Zach.
Absolutely. Yeah, so good timing on that, Stu. I'm a UW-Madison grad myself. Apologies, Anthony. I'm a principal and shareholder with the Dickman Company, where we specialize in mainly industrial brokerage. Been in the business for about 8 years, and yeah, looking forward to being part of the panel. Let's take it away.
Fantastic. I will just note that Mike, I believe you got your JD from Marquette. So
I did.
I know you went to undergrad maybe at Wisconsin, but
Yep.
Let's just say those are the 2 top schools in Wisconsin, right? And we'll move forward from there. All right. So I almost got straight into the question. So thanks for staying with me. And so now we all kind of idea. I think you get the idea that we got a variety of perspectives and real broad breadth of expertise in the panel. So I'm looking forward to hear what everyone has to say. So let's think forward very broadly for a second. So let's think about the next year. Where do you think the best opportunities in real estate are? Maybe start with Stu, since you're on my top left. You think you're on mute?
There you go.
There you go.
The steady performer has been industrial. And so it's in our areas continuing to grow. And I don't want to take too much away from Zach, but we're seeing the growth coming across the border. The thing that's also been surprising is we've been underweighting retail for the last 2 years, and we've been net sellers in all categories, but more so in retail. The cap rates on retail have moved enough that when you look at the cap rates and the cost of capital, retail is starting to look pretty interesting right now. Now, you got to be careful because it's a shrinking business, but we really are very happy that we have grocery anchored retail during this year. So that's a surprise to me.
Yeah. So Stu, I'm just wondering, there is more people ordering groceries online and getting it delivered. I personally hadn't found it work that great, but is that having an impact on the grocery retail?
It's the grocery industry has still not found a way to truly make money by delivering groceries. And so what they're doing is they're capturing market share. And if they can get people, they capture the market share, and then they get people to show up to the store, even if their product is pre-picked online. That's a profitable way of delivering groceries. Now, Kroger is taking a big gamble by investing in highly automated distribution centers that are designed to have direct delivery both to the consumer and to the store. So it's packed at the distribution center, then it can go to the store.
That's interesting. Yeah,
And
I think our modes of shopping are just going to keep on changing until we get this all figured out. So let's move on to Zach. So Zach, you're a real industrial expert. So why don't you kind of tell us what you think the best opportunities are? Maybe it's outside of industrial.
As far as opportunities, I mean, admittedly, I'm a little biased because I really only see the industrial side of it. But I do think there is definitely still opportunity out there. I mean, if you look around the marketplace, driving up and down pretty much any interstate, you're going to see new buildings popping up everywhere. Typically spec stuff that's built without a tenant in place. And the reality of our marketplace is, in order to I solicit that new tenant, you do typically have to build on spec, especially on the industrial and specifically the distribution market. And we at the Dickman Company are doing some of that development ourselves, and we're having a lot of success in that. And in fact, yeah, I mean, we don't have a whole lot of vacancy, and most of the spec stuff that we have built has filled fairly quickly. And we're still seeing great rate of return on that product, and hopefully we'll continue to do so. And even in the marketplace outside of just our firm, we do see most of everyone's spec getting filled quickly. And we do believe that'll continue. We're bullish on that marketplace moving forward, and we'll hopefully continue to take advantage of it.
Right. So the tremendous run of industrial continues, maybe even pick up a little, perhaps, at least in a relative sense.
That's the plan.
Yep. Very good. How about you, Danielle?
Yeah, I would kind of agree with everyone so far on the panel. Most of the deals that I see going forward are either industrial or I've seen a lot of multifamily projects going into 2021 that are kind of more in the mid-range kind of apartments and everything.
So mid-range multifamily is kind of an alternative. Yeah, and that's another market, right? I mean, the data that I see says the occupancy rates, are down, but it's not been like retail, right? So and there does seem to be some deal flow in the multifamily sphere. Yeah. Okay. So how about Mike? Yeah. Anything you'd like to add?
Well, I think I just echo what everybody said. Industrial is still going strong. It's weathered the pandemic probably better than any asset class. Multifamily is also, I think, an opportunity and to be a little different. I think it's specifically in the state of Wisconsin and some of the tertiary markets, senior, there's some opportunity there.
You want to tell us a little bit more about senior? I just anecdotally, my parents are in their mid to late 80s and they still live in a single family detached home. But I can tell you that they don't want to go to kind of an assisted living setup. I think if there wasn't COVID, they would have made that move probably this year. But they're in no rush to do that right now. And so anecdotally, I think this is probably going on in a lot of different families, and kind of how, so it seems like that. How do you think this is going to play out in the senior housing front as we kind of slowly, hopefully move out of this COVID era?
Yeah, I think that's what a lot of people see. And I think that talking with my clients, really what the headlines are grabbing is they're lumping senior, which is really a broad term for a lot of different service levels. And, you had mentioned assisted living, there's independent living, which is 55 plus. And then you've got your skilled nursing at the higher end of the care spectrum, so to speak. And really what's been getting hit hard, according to a lot of my senior housing developer clients and operators, is the skilled nursing. That's where they've been getting really hit hard by COVID. So with the anecdotes and the news stories focusing on senior housing, it has scared some people away, especially in the larger cities where there's even more density. But what we're seeing is in the smaller markets, there's still a lot of opportunity and there's still a lot of demand in Wisconsin in particular.
So you're still finding a strong demand for skilled nursing?
Not so much for skilled nursing. To be fair, I haven't done a lot on the skilled nursing side, but more so on the independent living, assisted living, memory care, the less acute care facilities.
Yeah. So what are the other options if I having trouble with my memory or I need a lot of assistance? What are other options besides going into a facility that people would have? What's the substitute if people are delaying?
Sure. There's home care is kind of the real alternative. And there are risks that you run with that. A lot of our senior housing developers, especially in newer product, are putting in safeguards in their HVAC that help minimize the risk of spread of the virus. And, it creates those social keeps those social spaces safe. And it keeps the staff and everybody in one location, so it's easier to trace if there is an outbreak. When you have home care, you have a single nurse or physician or physician's assistant going to multiple different individual homes, and it's harder to trace the comings and goings of different people. And so it's easier for an outbreak to spread. From what I've been told, I don't want to pretend to be a medical expert here, but that's the understanding, and that's kind of where my clients are seeing the benefit of senior housing, and they're not seeing a slowdown in demand, at least in Wisconsin.
Well, we all become seniors in the end, right? That's
Yep.
hopefully inevitable, right? And so we need this housing. So,
Exactly.
so Danielle, thank you for cracking a smile there on that. On that, I appreciate that. So why don't we switch over to you, Danielle? So, maybe you could tell us a little bit about opportunity zones, and how the activity. That was a year ago, right? That was really one of the main topics on everyone's mind. It's gotten supplanted by COVID and maybe the election. So kind of help us understand where we are kind of today, and where we think we're going in the medium and long term.
Yeah, definitely. And I'll kind of start with this very brief high-level opportunity zone overview, just so maybe folks who don't know what they are can understand what we'll be talking about here. But so opportunity zones were, part of the TCJA Act, and really have three main benefits. And those three benefits is a taxpayer will have a capital gain that occurs, and they're going to invest into an opportunity zone fund. And the three benefits that they get is they get initial deferral on that capital gain they're putting into the fund. And then their second benefit is they get a step up in basis depending upon the length of time they hold that fund interest. And then the third kind of main benefit of opportunity zones is if you hold that fund for a period of 10 years, you get to permanently exclude the gain on that appreciation in that fund. So high level, that initial gain that you created to be able to invest in the fund, you will, under current law, always have to pay tax on that. And right now that time period is on your 2026 tax return. And that kind of is the driver probably for a lot of the conversation I think we'll have on this panel based on the election. So, as far as like the market and what's going on with opportunity zones, I think a lot of it is probably where I think I said it would probably be last year when I think you and I were on this panel. And it's kind of, I saw a lot of people kind of rushing into funds who really lacked the knowledge of how to set up or do a real estate fund. And I think a lot of those funds have, kind of failed just due to lack of knowledge and what the environment really demanded. But I've also seen a lot of success in people's funds and their developments, both on the qualified opportunity zone business side, so a true operating company, and on the real estate side too. So it kind of depends on which lens you're looking at. There were definitely a lot of cowboys or dreamers coming into this when it initially started who just thought they'd raise a huge amount of capital, but didn't actually know how to manage the deals. But in general, I think we've seen about $12 billion raised for opportunity zone funds as of September 2020. So there's definitely a lot of cash going into it. Short term, we've definitely seen a pause because of COVID. I think primarily because people weren't sure what to do. So a lot of projects paused, I would say primarily between February and June time. However, in the last few months, I've definitely had a huge uptick in people, revitalizing these projects and wanting to kind of move forward with them. So kind of like what this looks like in the future, I think, since it is a program that has bipartisan support, I don't think it's going to go away. So really, it's going to be the lens of whether or not we're looking at Biden administration or Trump continuing. So Biden, supports opportunity zones and the program itself. I think what we look to with him is probably his change in the capital gain tax rate, because even in the past 2 years, that was always the question I got from people, because it's a deferment of the capital gain and not the tax. So a lot of people, their biggest question to me was, well, why wouldn't I pay the tax now when I know my max tax rate is 20%? Who knows what the tax rate will be in 2026? Why would I gamble that? And with kind of Biden's tax plan, that has kind of become a real concern for people. I think his tax rate, capital capital gain tax rate is 39.6% as the top tier. So that's a substantial change from the 20% that is currently under law now. So that's a big concern for a lot of people. Additionally, I think he's a huge proponent in more reporting, and certainly the accountant in me loves more data and really to know and understand and see proof of concept of these. But at the same time, kind of being an advocate for those fund administrators, it's a lot more onerous work to kind of get all that data together. It's another box to check when putting these deals together. And depending upon how much reporting it is and how much red tape, it could really even lower the returns of the deals as well. So it's a kind of a lot of things to consider. He's definitely a proponent. They're not going to go away, but there are a few more factors to really think about. We're kind of on the flip side. You know, Trump is looking to really double the areas. He's also looking to kind of extend some of the opportunity zones. You know, what we saw a lot of when people pick these zones, many of the communities, they really didn't understand what they were picking. They were kind of using half information and kind of guessing on what areas would really benefit. And a lot of them are now looking at them like, you know, if I really would have understood this, I would have picked XYZ communities instead. So I think he's looking to expand that as well, and also looking to extend that 2026 tax deadline for when people actually have to pay the tax. So high level, you know, I think there's still a lot of opportunity for opportunity zone funds to keep going. I think a lot of people are nervous about the election, but I don't think that really should stop a lot of funds that are, you know, kind of already going now and or plan on going. I think it's just kind of another calculation we have to do if, you know, the capital gains tax were to increase. I think overall it'd still be a benefit if we look at the 10-year hold period.
Great, thank you. So I guess my one question is, so is the industry's understanding of opportunity zones improving? You know, when you see these funds, is the quality of the funds improving over time?
I think it depends. That's a really good question. I think there's a lot of communities that are working, like WIDA does a lot of work of trying to educate people on opportunity zones, and we do the same thing in Minnesota. But I would still say the people who are first coming into opportunity zones, and when I work with other CPA firms or law firms, I think there's still an education gap there that can be a hurdle for a lot of people going into it. So that I think they have a tendency to go into the deals not quite understanding all the facts still.
Yeah, and so when I think about these locations, I think an opportunity zone should be in a semi-distressed area, right? So a place that needs investments, and that's a harder place to do real estate, right? It's much more challenging, and it seems like that's a type of place where you need someone really local and really understands that market, right? And has good real estate skills. Do you kind of is that kind of my, I'm not involved in this. So is that kind of what it is? And so that, I think this could, I remember having 3 or 4 professionals say, hey, I'm going to do, should I invest in this opportunity zone? I was like, I don't know anything about Texas. I can't tell you, right? About whether these investments are good or not. What kind of takeaway on that, this kind of feeling of mine about that?
Yeah, I would definitely agree. And I think that's why there's a lot of state organizations trying to work with those smaller communities to offer them the resources so they can help explain and kind of promote their particular opportunity zone property in a way that they understand it and the investor can understand it. I would say the Midwest, I think, lags a little behind some other communities. Like Colorado has like an acceleration program for any of their zones, and they kind of go to the top of the market for approval. So it'd be nice if we had a little more around that, but I think in general, the different state programs are trying to give those resources to these smaller communities. It's just, I would say we're probably definitely a little lagged.
I think it's a great time to kind of throw this out to the panel, and maybe some of you, I'm sure, have experiences working in opportunity zones, and kind of maybe you could relay your experience and your thinking of investments or transactions you've been involved in. Anyone out there?
Anthony, we have one project that we're actively developing that's in an opportunity zone. We also own 4 additional properties that are in opportunity zones, one in Chippewa Falls, and the other 3 are in the city of Milwaukee. And we kept it as a real simple structure from the opportunity zone part of it. Everything else about it's very complicated. We already own the property, and we brought 2 additional partners in. One of the partners traditionally would have gone into a 1031 exchange. He had sold a piece of real estate that was held by not only the patriarch, but his adult children. And then the other person that came in, the other husband and wife group, I should say, that came in, had sold an interest in a business. So the money came in both from real estate and from a business, which is one of the flexible things associated with it. And then we layered on that investment with new market tax credits, historic tax credits, and then we put a little bit extra leverage on there with PACE, and we actually overfunded it. And there's some real dicey things that come into play with making sure that those dollars are getting into the asset and being put to work. And so, you know, Danielle's expertise in this is it's unique. And one of the things that I'm curious about is whether or not she has worked on placing some dollars in the indirect model, where 10% of it has gone actually outside of an opportunity zone. Because that's one of the subtleties that's within this. You can actually, and I haven't seen anybody who's actually come forward and said, this is exactly how it works, but you can take money and put a portion of it also outside of the OZ.
Yeah, so I think what you're referring to is probably the, less than 5% of the assets can be non-qualified financial property. So that technically that piece can be invested elsewhere. I've definitely had a lot of people want to do that, and I think that will be more of a question going forward for funds as they get into the same position as you, because a lot of the ones I'm in are really still in that development phase, so they haven't come across that problem, but that they're at the point where they're almost like, crap, I'm going to have X amount of cash still here, and I can't just keep, adding to this building. What am I going to do with that? So I've had a few situations from a operating business perspective where we had to figure out what to do with the cash. But from a real estate side, since most of them are kind of still in the development, we've just kind of started those conversations.
Great, thanks, Danielle. I think this would be great if we could shift back to industrial, back to you, Zach. I was on one of those many NIAP calls, right, that we're all on occasionally, and I remember there being a discussion about potential oversupply of industrial space in the kind of the Chicago area. So I was wondering that maybe that'd be good kind of starting off point. Are you seeing any evidence of that anywhere in your market? And just kind of give us an idea on the risk spreads and what's going on in industrial.
Yeah, great question. Thanks, Anthony. I personally don't see evidence of oversupply. And I think part of the reason for that is the land for new industrial development is actually scarce. When you look at the stronger markets in the Metro Milwaukee area, with the orientation to the interstate being such a big factor on the industrial side, it's just sites are hard to come by in order to develop. And I think that'll continue to kind of limit oversupply. And if you just look at the product that has been developed, there isn't a whole lot that have sat vacant for more than a few months. And I think even what we've seen, in addition to newer developments, is repurposing of other either older product, Class C. You see it in the Phoenix Investor Plan, and they've done an absolutely phenomenal job of that, is repurposing older industrial buildings for that use, especially ones that have strong locations. And then to follow that up, you've seen even some retail be redeveloped for industrial. So I think ultimately oversupply isn't really a concern on our, at least as far as we're concerned in the brokerage side of it. I think it's a lot of people are continuing to try to meet the supply by trying to find new ways to develop it beyond just new construction. And in my viewpoint, I see that kind of continuing. The only barrier to entry being, and can you get the zoning to redevelop some of these other properties for industrial uses? And I believe that'll continue.
So it's really, from your perspective, it's really about finding the sites that work, right? That's kind of the limiting factor on the supply of new space. Right?
That's exactly right. Yeah, it's a challenge.
Does this have to do with getting to the last mile, or you think, or is this the kind of the huge big boxes and more open? What portion of kind of industrial is?
Yeah, I do think
site starved.
I do think the last mile has a lot to do with it, with e-commerce absolutely blowing up. Proximity to interstate, travel times to suburban areas are a huge factor. And frankly, within the Milwaukee, there just isn't anything out there in terms of sites available to develop this. So I do think eventually you may even see some infill development. But right now you look up and down the 94 corridor from the state line to Milwaukee, and a lot of those sites or those lands that would work for development have been developed. And the ones that you don't see developed, that you're going to look and you see, yeah, farm left and right, but then you check, and a lot of those sites are impacted by water or wetlands. So I think a lot of people aren't aware of this, but there is not a lot of land available for industrial development, and the stuff that is oftentimes already controlled by industrial or institutional developers, and they're just kind of waiting for the demand to continue, I guess, before they build.
So you kind of see, a continuation of, high occupancy rates and compression of the cap rates. Really, that's kind of the story you're telling, I think.
I do. I think there's still a lot of money chasing industrial, and I think a lot of that coastal money is seeing the cap rates here in the Midwest, and they're still not. We still see higher returns here in the Midwest than they're seeing. So I think a lot of that money is still coming into our market, and I think it will continue to, and I think we'll continue to see industrial development on the rise.
Well, I got one more follow-on question, if that's okay.
No, that's fine.
So thinking about, when I think about industrial, I'm thinking about fulfillment centers, right? So I'm thinking about Amazon, and what kind of, of the deals going on out there is, what can you give us a ballpark? What's Amazon's fraction of the deal flow? I mean, I hear anecdotally people talking to me, oh, it's all Amazon. There's nothing else going on, so maybe you could help us understand that a little better.
I don't think that's the case.
Okay.
I think there is a lot of it out there, and there's a lot of rumblings, and you do hear kind of through the grapevine in the brokerage community, oh, they've looked at this and they're really close with them on this, and I can't say where that is, but it's you do hear their name out there a lot, but by no means are they a market share for us. There's plenty other tenants and users out there, and I would say they make up a very small amount of what we as industrial brokers are working on a day-to-day basis.
Good. That's good to hear. So next time I hear that, I'm going to push back and I'm going to quote you. I'm going to say
you can do that.
It's not all Amazon, right? It's
That's
a robust market. All right. I think I'm going to we'll shift over to you, Stu, and maybe think about where we are today and kind of the future, thinking about, how's occupancy and leasing velocity, across your kind of different property sectors, kind of give a feeling what's going on, kind of how you're thinking about the future.
Boy,
Pretty broad, I know.
It is.
I give you a lot of leeway.
Okay. Again, we're in retail, we're in office, we're in multifamily,
Well, pick
industrial.
one. Maybe start multifamily.
Multifamily is one that is shifting. We get weekly reports from all of our competitors showing traffic, showing occupancy, showing new leases, and then they quote their incentives. We do not talk about lease rates. Okay, so I just want to get that out there.
Mhm.
That information is typically available through CoStar. And what we're seeing occurring in the urban areas, and Madison is a completely different world than Milwaukee. In Milwaukee, we're seeing a lot of concessions occurring on the east side right now. And that's both east of the river and in the neighborhoods west of the river. Walker's Point is holding up fairly well. There's not as much information available. And here's the thing that I find disturbing. This is the last time I've seen this. Last time I saw this occur was in 2008. The reporting that's being done is not as accurate as it was 60 days ago or 90 days ago or 120. So we're seeing a deterioration in the quality of reporting. And we compare the data with the investment real estate brokers and then with the bankers. And we're seeing some disconnects occurring. So, but we are seeing general increase in vacancies. There's a small handful of landlords that are able to sustain their occupancy, but they're doing it again through more concessions. The suburban areas, suburban Milwaukee, the southwest is holding up fairly well. West side, Wimmer Brothers have some very nice projects hitting the market right now. Big projects, and it's definitely disturbing the overall equilibrium in Waukesha County.
Mhm.
Now you switch to Madison. Projects that have been up for more than 2 years in Madison, very stable, of not many concessions, high occupancy rates. And we have one project on the east side of Madison, just a stellar performer. Our lowest occupancy in the last 12 months has been 99%.
So Stu, why is that? Why is it, why is the market like that in Madison, a little looser in Milwaukee?
Madison, there's a much stronger parallel between the skills of the workforce and the jobs that are available. And Milwaukee, we have a higher percentage of service workers. Some of them were very well paid, and we're seeing some of them moving back home. 12 months ago, and I don't always know what statistics to believe or not, but 12 months ago, the statistics that we read said about 20% of young adults were still living at home. And those who have children, many of those have bought their own homes. And those that don't have children, we've been told 30% of that demographic has moved back home.
30%.
Yeah, so they're enjoying.
It's an amazing number.
So they're enjoying the benefit of laundry, and in some cases, their parents are enjoying the benefit of somebody else who's helping out with the cooking.
Well, I remember reading the newspaper, and there was some, gossip column, and it was like, my son moved back in the house. How do I get him out? Right?
So,
I think that could cause some conflict too, right?
yeah, so we've seen kind of a reverse of household formation.
Yeah.
I think once people are, listen to Warren Buffett. When we came out of the last recession, Warren Buffett said, "Hey, when people start having kids, they're going to drive the single-family market." He was right.
Mm-hmm.
But the other thing is, you don't have people. People aren't meeting new friends, creating new relationships, and in bars and restaurants and in sports facilities. So it's going to take a while to recover.
Yeah, I mean, we're a bit very antisocial right now. I mean, this is the basic setup. I can say as a professor, many of my students come tell me, everything's okay, but I don't get to talk to you. I don't get to meet new people, right? Like they would meet, and when they get out of class and they just bump into someone, talk about it, and make new friends. They're not making new friends; they're keeping to their little core unit. And so, that's how do you find your future wife, your future husband, right? If you're not meeting new people, so that's a real challenge. So maybe kind of open up to everyone, but let's think about this group that's back at home, and where are they going when they move out? So let's say it's 6 months, 3/4 of a year from now. What do you think? What is the path of the young adult at home? Anyone out there? You don't have to be in it,
Right. I can tell. I guess I can talk about. Yeah, I can talk about what some of my peers have done. I'm 8 years removed from college, and what I'm seeing around our friends that are in the city or fresh out of school as well. And I think it depends a lot on your employment situation. But coming out of school, a lot of kids nowadays they're saddled with student debt, and they're forced, once they're out of the house, to rent, obviously. And if it's downtown, it's typically in a duplex or apartment building. And realistically, in order to transition from that point where you're renting to buying, you need a stable job history, at least 2 years, and you need fairly solid cash reserves in some cases, or not having that situation where your expenses are so high. And I think you're seeing a lot of kids coming out nowadays. The timeline between when they can buy and when they get out of school is a lot longer. So I think that's why the apartment market is so strong in those downtown areas. And recently, what I've been hearing from my peers and what I did personally was I moved out of the city. I think the attraction of the city is starting to be impact on my generation. I think the availability of bars, restaurants, social life, things that we go down there for, we're seeing that obviously in the immediate term come to a complete halt, but we're also looking months, years down the road, and it appears that this isn't going away, and it could be changed permanently. And it draws away from the attraction of that. And for me personally, and that was a huge factor in selling my condo downtown and moving out to the suburbs. And I think that will continue, especially amongst those who are preparing to purchase. As they continue, or as they consider it an investment, they may opt to invest somewhere where the long-term outlook is a little easier, I guess.
Yeah, so we have, I think you're making a good point that we were beginning of the Warren Buffett transition, right? That was already in play. I think a lot of things that happened COVID is made things that were going to happen, they started to happen now, right? Versus later. So I think this is an example of that type of setup. So maybe any other comments from anyone? If I read articles, I can see that I meet multiple people and read multiple articles where people say COVID's killed the city. How do you kind of react to that?
I think in the short term, that's probably accurate. I think that there will be a group of people that do move out to the suburbs and even the exurbs, and they may still rent out there. I think that there's also the fact that, anecdotally, you hear of a lot less compliance with mask ordinances and capacity restrictions the further you get away from the urban centers. So I think that allows for you to have a social life if you're not concerned about the virus. And as a younger person, there's reason to believe that you're not as susceptible to the worst case scenarios. And I think that does influence behavior. And if you're allowed to have a social life outside of the city and you're not allowed to have one in the city, I think Zach is exactly right that a lot of people are going to keep moving out of the city, at least in the short term, because you're able to live your life somewhat more normally further away from the urban centers.
Anyone else have any kind of reactions to this idea? This is an idea that's out there, right? This, especially if people thinking about places like New York City, right? There's, so what about, for our big cities in this region?
Anthony, I'm still a strong believer in the urban area. You got the cool restaurants there. You got the sports facilities downtown. You got arts, culture. It doesn't work quite as well for somebody who's, they have 2 kids, one being 5, one being 8, and they're focusing around school. But if whether or not it's a boomer, which are most of them are empty nesters right now. There's still a few with children at home, adult children at home. I think they're gonna go back to the city as soon as there is a vaccine available, and I'd be willing to make a major bet on the entertainment industry once there's a vaccine available, and that'll cause a boom and probably a new rebirth in the urban areas. People are going to be so hungry for social interaction that you're going to see that whole sector explode. But the vaccine has to be out there. It has to be something that people feel is safe.
Right. So you really do see kind of a big V-shaped recovery, maybe kind of experiential retail.
Yes, and and to a little bit extent, it's the next 48 hours will go and tell us a little bit. It looks like right now, unless something has changed in the last 60 minutes, it looks like Vice President Biden may be our new president. It looks like we solidly have a Republican Senate. So that should be good for the real estate industry. And you're probably saying, why is that? Because right now, the current tax code is very, very friendly for the real estate industry.
Mm-hmm. And so with that split, nothing will change, right? It'd be hard to pass legislation to reduce that.
I hope there isn't going to be a big change. We've learned in the past, no matter who our president is, we roll with it, we adjust, we learn what the rules are, and we figure out a way to go and move forward.
So maybe this is a good time to think about these, the moratorium on evictions and kind of the stimulus bill. So maybe one or two of you give me an idea on how that's been affecting the businesses that you see and how it's changing strategic behavior in the marketplace. Great.
Yeah, I would say that the eviction moratorium has frustrated a lot of our landlord clients because it really does put a lot of pressure on them to not be able to turn over units. Many of our landlord clients were taking the time to work with their tenants. Like there's not a rush to evict somebody and get somebody new in there. It costs money, it takes time. It's not something that they're looking to do right away. But if you're unable to get to evict somebody that is not paying rent, and especially if they're gaming the system, that can hurt the landlord, and they have lenders that they have to pay, and it puts a lot of stress. But from what we were hearing, the stimulus plan, when the stimulus was passed back in March and April went into effect, that made a huge difference. There was very little delinquencies from what we were hearing. In fact, there were some interesting studies that were showing that the savings rate actually went up. So people were paying their necessary obligations and sitting on the money because they weren't sure what was going to come next. So people were being smart about it in a lot of ways. So, if we get another stimulus bill shortly, which it sounds like that's likely to happen. I think that things will be fine. And the eviction moratorium will hopefully not be a big deal. But for some, there is some stress for landlords.
Yeah, I remember talking to people from an NML, right? Kind of the peak of kind of the unemployment. You know, I forget what the unemployment rate is, like 15, 18%. And, you know, I asked them, you know, can you imagine, you know, your 90% on-time payment with 18% unemployment rate? If I said that to you a year earlier, I think, you know, you would have laughed at me, right? But we had the stimulus bill, right? So then that was a big piece. I think, I would like people's reaction. I think people don't have opportunities to spend their money. And so going on the summer vacation, right, was likely delayed or kept very local, maybe just pure Airbnb or something. So I think incomes, yes, were down. People had less income flow, but they're also spending much less money on all the fun activities. You know, for me, I canceled my gym membership. You can only see the top of me, so you don't see the big impact. Right, but that's that. So you know, I tried to work out in the down here, but you know, it's much easier in the gym. So that was a huge expense, not going out to dinner. So my expenses were down, right? And so for me, that was it. So how do you kind of explain this kind of, you know, it's the economics hasn't been as bad as it might have. If you would run out this scenario, I think you would have thought the economics were even worse than they've turned out to be. Which kind of any kind of feelings about that in the panel?
Our world is a little bit different out here. It's lower density, and as Mike said, there's more people that just don't want to wear a mask. I'll tell you, I'm not real keen about walking into a bar out here, but as far as the restaurants go, they've reacted. They spread out their tables. They're really promoting their outdoor dining. This is a great week for that, and they are packed. But the servers are wearing a mask. We appreciate it, and so yeah, people are not spending as much, and yet I think there's going to be big pent up demand. And Anthony, I have a question for you. I mean, if you knew that it was safe to go into the gym, would you have your membership right now? Because I'm curious about that.
I'd do it right now.
Okay.
Yeah, I'm just not confident enough to go to the gym right now with the spread of the virus, and you know, to me, it's too risky. Yeah, so I'm not doing it till I have the vaccine, basically.
The people in our office are telling us, hey, we don't miss the commute, but we do miss seeing each other, and we can't wait until the office is open full time. Right now, we have 20% of our team comes in every day in the office, and they do like seeing each other. And when they are getting together, when they come into the office, they're spending more time with saying, let's have lunch together. Let's, as a group, they head out. And that's something I really appreciate. They truly care about each other, and they like spending time with each other.
Yeah, I mean, when I go to the office, if I see someone at the water cooler, you know, I'm going to talk to them, right? To actually get to talk to someone. So maybe you mentioned a little bit about design changes. So maybe, are there any other kind of changes in property and how it's going to be organized? I don't know. Think about maybe office and multifamily. Are we going to see substantial design changes come out of COVID?
I would really appreciate some feedback from some of the other people on the panel.
Yeah.
What we are seeing right now is people who, and on our national forums, we talked about this. People are leaving the really dense cities like San Francisco and New York, and some of them are even looking at areas like Milwaukee, where we have low rise, and then we also have we have the benefit of having affordable, high quality housing options throughout the metro area.
Yeah.
Now, Danielle, curious what she sees from her marketplace also.
Yeah, I've seen probably a lot more demand, or, you know, from what clients have told me, a lot more demand in kind of people having their own space. So either making sure that there are kind of less shared areas between different tenants, if we're thinking about an office space, as well as people kind of want their own air system. A couple of my clients who feel like they were really successful during COVID. Were those that had kind of their own system. The tenants weren't worried about coming in during COVID and having to disrupt kind of their workplace because they didn't have to, you know, share their, you know, HVAC system with everyone else in the building. They just had to worry about their own kind of protocols in their own space, had their own entryway that was exclusive to them. So I've seen a lot of people say success from that area in the office space.
So that's less likely to be a tower, right? So people are kind of a low rise single entry to their own space. So is there this sounds like a geographic story too, right? Of a more suburban demand versus city. Is that what you're kind of seeing?
Correct. Yeah.
Yep. Okay. We're getting towards the end of our time. So Danielle, maybe stick with you. Is there any, kind of thinking about the tax side or anything for your business that you think we should kind of know about as we're kind of getting to the end of our discussion here?
Sure.
Yeah.
And I think kind of Zach had pegged this question when we were doing our prep call, but it was kind of in line with, different tax changes that may happen, if Biden were to get elected.
Yep.
And I think a lot of us kind of already have heard about the, increased tax rate he's looking at based on income level. But I think the real fear is the repeal of like-kind exchanges, if that ends up moving forward, again, based on income level. And a lot of research done on 1031 exchanges, it would be kind of a disappointment for the market. I think they average about 10 to 20% of the transactions that are real estate are 1031 exchanges. And they've actually found that generally speaking, people end up paying more tax, at the end of the day after the kind of second flip when they're getting rid of the 1031, pending they don't do the hold kind of die routine and get the step up in basis at the end. So I think that's a concern for some people is, the repeal of like-kind exchanges. Hopefully, that kind of doesn't move forward. We're looking for, final regs right now that are in the process of getting finalized just based on, changes from TCJA. But I think that'd be one of the bigger things that kind of would affect real estate aside from, kind of the obvious, tax rate increase and some of the repeal of the CARES Act that could happen.
Thank you very much. We should have spent more time with you, Danielle. I think, any last comments about maybe on the industrial side?
Yeah, echoing what Danielle said, I do think if that were to be affected and there was a change in 1031 or the ability to do a 1031 exchange, I do think that would negatively impact both deal volume on the industrial side and specifically the investment market and potentially even pricing, because you do see people that get into a situation where they're going into a tax deferred exchange and they have to identify properties in a timely manner and then close by a deadline. And so some people do end up agreeing to purchase prices for more than what the open market might fetch, or and they end up, to avoid the taxes, closing on these types of properties. So I think if you don't have those transactions in the marketplace anymore, I think that could negatively impact top end pricing. And I ultimately, I think it'll hurt the brokerage market for sure, because there's going to be less deal volume. A lot of my business is, I'm not selling this, or what I hear from clients is, I'm not going to sell this unless I have something to trade it into. And that's our favorite challenge, because that's two deals. And if that goes away, I do think it'll affect brokers as a whole.
All right, so that's a potential change. Yeah, but I think as Stu indicated, change is going to be difficult if we have two different parties in the federal government. How about you, Mike? How about a kind of a last word from you, Mike, before we wrap this up?
Yeah, I guess I would echo everything. With the split government it looks like we're going to have, I think that any real change is going to be difficult. So I'm not worried on the legal side. I think it'll be interesting to see what markets bounce back and when. I think that a lot of the restaurants have transitioned well due to COVID and have started expanding their offerings, and it's actually bringing in more revenue streams. So it'll be interesting to see what normal looks like going forward.
Yeah, I think, Mike, you're right. And we're all hoping to get back to normal, and we're not 100% sure what the new normal will be, right? And so we'll see how that goes. So Stu, I'm just going to steal from you. So I just want to repeat one of the most interesting things I think you said was that this pricing has gotten to the point where there's real opportunities in retail in the right segments. So you're the first person I've heard say that in a while. So I think that was very interesting. The opportunity zones with the right funds and the right people can be successful. A little weakness in the apartment markets in Milwaukee, especially as compared to Madison. And then there's a very interesting exchange discussion at the end. So there's some potential hiccups if we get some changes in the exchange front. So thank you everyone for spending an hour today. It's gotten a little sunny out, so that's nice. And I want to hand that off to the next panel. So thank you everyone. Thanks for your time.
Thank you, Anthony.
Thank you.
Fantastic. We made it to panel 3. I am going to try to share my screen to start panel 3 properly this time. Oh, where'd it go? Let me get there. Okay. Follow the old guy as he tries to navigate. From current slide. There we go. This is us, right? Downtown and suburban developments, game-changing projects. I'm just going to flip through the slides here real quick with your bios on them. And then I'm going to turn this over to Richard Donner. Have a great panel. I'll still be here if you need me, and just go through your intros and then we'll rock and roll. I see everybody's here, right? I see y'all came in as Alyssa Galinsky, so I got to apologize for that. That was mea culpa. I'm going to change your names, though, if you didn't change it already. I see Burton and Callie already got that. But so here we go. You're off and running, Richard. Go for it.
All right, thanks, Todd. Welcome, everybody. My name is Rick Donner. I'm a shareholder in the real estate group at Reinhardt Berner Van Duren. It's a pleasure to be with you here virtually. Hopefully next year we can all get together again, physically get together again. So this is panel number 3. It's downtown and suburban developments, game-changing projects. In the last few years, the city and its surrounding area have seen many transformative projects: the Pfizer Forum and the surrounding Deer District, Michaels River 1, BMO Tower, Komatsu headquarters, and then going into 2020 and the then pending Democratic National Convention being held in the city was really experiencing unprecedented momentum in commercial real estate. And how has the pandemic impacted that momentum, and what are the opportunities? And we've got a distinguished group of panelists that will be discussing those topics. And I believe if the technology cooperates, we can answer some questions from the group, but not precisely sure how that works.
Correct.
But,
everybody has a chat room. I don't know if they see it, but go to the bottom of your screen. You see a chat. I'll go in there and say hello again, and then that's a great way to communicate.
Okay, and so then but the people watching can answer questions, or ask questions that way?
Correct. Go in the chat room. Make sure it says that you're talking to all panelists or all people.
Okay.
If you don't, I'll fix it for you on the fly. But yeah, try to get that who you're sending it to. They should be able to ask questions.
Okay, excellent. So you will be able to ask questions. Let's have our panelists introduce themselves. Callie, why don't we start with you?
Unmute your mic.
Here we go. Had to click it a few times. Good morning, everybody. I'm Callie Berg. I'm the Director of Economic Development for the City of Franklin. And I have been here about 2.5 years. Before that, I had about 20 years of economic development experience in Michigan and served at the county, state, local, and city level. So I am still getting up and running here in Milwaukee County, and I am thrilled to be part of this panel this morning. So thank you for having me.
Excellent. Burton?
Hey, good morning. Burton Metz, President of Acquisitions and Investments for Oneguard Partners. So I've been at the company for about 10 years now. And for folks who just listened to the last panel, Stu, our CEO, also presented. But we do, we manage, invest, and develop in industrial, multifamily, office, and retail. So a variety of different asset classes. Our focus is right now kind of Southeast Wisconsin. We're looking to expand beyond that as well. We do about $100 million of development and acquisitions each year, and that'll be the target for next year as well. So we work with a lot of municipalities here in Southeast Wisconsin, and can do traditional kind of debt and equity structures, and then we also are well known for kind of a more creative and complex type of capital stacks with opportunity zones and new markets and TIF. So that's a little bit about us.
Excellent. Ira?
I am Ira Singer of Mosaic Construction and our affiliated brands Design Construction Concepts and Cannabis Facility Construction. Headquartered in Northbrook, Illinois. I am a 94 traveler up from Illinois to Milwaukee and beyond, as we are in the renovation business. We have offices in Milwaukee and in Chicago. I work on business development, head of marketing and team culture, and production. We work in a variety of different remodeling and repurpose value add opportunities amongst a variety of asset classes. Multifamily and commercial are certainly in our wheelhouse, as well as single family cannabis, which has brought us to a national presence in 10 states. We're excellent at construction management. We solve for preliminary budgeting, what improvements and makeovers will add to the ROI and sizzle. And that's a little bit about us.
Excellent. Thank you very much. So we've got a great group here. It's each has an individual perspective that I think will be interesting. Burton, why don't we start with you in the main topic? What current projects in the pipeline do you see as transformative, and how will those projects change the city?
Yeah, I'll talk a little bit, about some of the projects that we're doing that I feel are transformative, and then really a couple others that I think are transformative for Milwaukee too. So we do a variety, kind of in the suburbs as well as city of Milwaukee. So in Milwaukee itself, we are doing a project in Walker's Point, which in itself is a transforming neighborhood. And this is a piece of that transforming neighborhood. So we're taking an old 100,000 square foot building, restoring it into an innovation hub, and kind of creative office space. And, and that's going to be really bringing some of the jobs and some of the activity and safety, and kind of bringing some of the historic fabric and reinvigorating that historic fabric into Walker's Point area. And then also with that, bringing some of the technology, innovation, big businesses under one roof, so that at the end of the day, it's helping really create generational wealth for the companies that are going to, or for the employees that are really going to be there. There's going to be a training center there for tech companies and for coding camp. And so the purpose of that is to really be able to bring in folks from the community who haven't had that opportunity to kind of be trained in technology and help them get into jobs that need that technology component to it, and really truly create that kind of generational wealth without the debt burden of maybe a 4-year college. So that's one that I think is very transformative of the neighborhood in Milwaukee. And we have a couple suburban projects that are more mixed use as well as market rate, and then we're working on a 149-acre business park in Sussex as well, which is really one of the first business parks to be done in the last few years in Waukesha County, which, if you're in the industrial side of things, it's not a lot of vacant land that's currently available.
Kelly, what's your perspective?
So in Franklin, what has been transformative for us has been something outside of our control with the opening of the Elm Road interchange on I-94. It's opened up a 500+ acre future corporate park that we have literally a stone's throw from I-94. It's got visibility, and we are in the process of putting in all the public infrastructure. So we've had a lot of interest over the years. We've been trying to do this for 15 years now, but it's really only been in the last couple of years with the pretty much confirmed thought that Elm Road was definitely going to be happening, that we've seen a huge uptick in developer interest. In addition, we have Ballpark Commons. I'm sure most of you are familiar with it. It's the Rock Sports Complex. And that's also in a TID, and we've been working closely with the developer, helping to bring additional businesses into the Ballpark Commons area. Velo Village, through the Mandel Group, is putting in 256 high-level apartments. We have a senior living component, and Lux Golf is coming, an indoor performance sports village, and of course the stadium, which is the home of the Milwaukee Milkmen. And then we have another TID in the southwest corner of the city. And I think you'd have to live under a rock to not know that that's going to be the future home for Strauss Brands. And those of us who've been working on that project for a couple of years have been very thrilled. And I think that's also going to be very transformative. So in each of those three areas, we're seeing transformation through activities by either the development community or by WISDOT.
Excellent. Ira.
Transformation is in existing buildings also. That's one of the great things about, design, build, construction, is it allows for an existing asset to change its personality. An office building doesn't change too much, but one of the transformative properties that we're proud to be affiliated with is the Novel co-working office building in downtown. Novel is out of Chicago, and we are working on some of their assets there, but they're a national company. And they have spent most of their asset acquisition in major markets. And so to look at Milwaukee and see an existing building that transforms into micro offices, which is their business model, which is transformative in that it supports the small business owner. That's its target market. It supports the entrepreneurs and tech, while the design in the buildings is great. It's got terrific energy, and it's it's something that they have successfully replicated. And when you see a building like that in Milwaukee, I think that is speaking. It's putting a stake in the ground for the small business sector, and big cities are built on small businesses. So I think that is also a very transformative project.
Excellent, excellent. Obviously, we're still in the middle of a pandemic. We're 7 months, I believe, in from the stay-at-home orders shutting things down. What were your initial development plans for 2020 before the pandemic, and did those plans transform to fit the current sort of new normal, or were they eliminated or pushed into the future? Burton, we want to start with you again?
Sure. I guess I want to go back on the other question too, real quick, just to recap. Sure. I think two other projects, I think, for Milwaukee itself that will, I think, transform kind of how people look at us from a capitalist perspective is, I think, Couture and Ascent. If those get built, I think that will change Milwaukee and how we're looked at for both kind of employers and employees coming to Milwaukee, where you kind of have another luxury apartment opportunity and a different way of building in Milwaukee as well. So I do think those will be transformative as well. So
what do you mean by a different way of building?
Well, just with Ascent, being able to have that wood structure in Milwaukee.
Structure,
yep.
Mm-hmm.
Yep. I think it's going to continue to get coverage, and I think it will. I think it's at least going to put Milwaukee on the map for some other capital providers.
Right.
So I guess going back to your other question on kind of COVID, of what it changed, the existing pipeline, obviously you're pushing that through, where there's definitely struggles on the construction side of just making sure the proper procedures were put in place and, any of the employees were kept safe. That's first and foremost. But, there was definitely, right away, there was definitely some some of the materials that they simply couldn't get over from China or overseas, that you just had to quickly pivot and be able to kind of source from a different location, whether that's from the US or that's from a different country, that you could be able to bring it to the US. So that's one thing that kind of quickly we were hit with. And then obviously managing our projects, our existing portfolio, our property management team, they were working countless hours, be able to kind of work hand in hand with all of our tenants to making sure that they stayed healthy, financially as well. And then we worked with them, to help them get over some of the issues that they were having with COVID. And I guess, the other piece of it that, for looking forward with COVID, of how it changed us, what we're looking for is, really diving more into the details of our underwriting and knowing how the debt and equity works. There's those, both debt and equity are different parameters these days because of COVID and the uncertainty going forward on new opportunities and where people are also ultimately migrating to from a job and employee perspective. So it definitely changed how we're underwriting going forward.
Yeah, and your property management point too, I've been really impressed just how much work and how well property managers have done, basically on the fly, nobody knowing what, not only on a practical level and maybe in their buildings or managing their properties and the individual tenants and retail customers, but also just dealing with the government, the uncertainty and some of the regulations on both the state and local level, some of them changing, with the court rulings. And so it's been quite impressive to see how well I think a lot of these properties have done. And most buildings in the city remain open and operating. I mean, obviously individual companies are making their decisions to not necessarily have everyone together or work, our firm works on a rotating system, or it had been until the uptick recently, but where we'd come, different shifts, if you will, would come in on different days. So I think that's been an example of people really stepping up and doing a great job doing this. Kelly, how about you? How have development plans changed for Franklin, if at all?
So very little changed, actually. My primary role is working with large commercial and industrial. As with all communities, we're seeing that some sectors in the service industry and hospitality and so on are struggling. Mm-hmm. But in the industrial sector, I'm probably busier now with prospects and potential and upcoming projects than I've ever been. The only real thing that we've been impacted by was in early June, we had a TID that was in the corporate park area out by Elm Road Interchange. And we had a lot of money in increment, and we had all these plans. We were gonna redo a bunch of roads and put in a bunch of roads and this, that, and the other thing. And then we ended up pulling back the reconstruction of Elm Road with the corresponding underground utilities and moved it into the new TID, because we were concerned that if the economy tanked and land and real estate values tanked, that we might not have the increment to cover those costs within the next 5 years. So we pushed that cost into the new TID. And so now we've got a TID that doesn't have increment. And so in that regard, it's made it a little more challenging. We have to be a lot more careful on our public infrastructure spend. But we are also seeing at the same time that because the industrial market hasn't seemed to slow down, that we do have a lot of proposed projects. And I'm confident that we'll be able to get it all done. But that has been a bit of an impact due to COVID. And of course, working in the public sector, all City of Franklin employees are considered essential. So we're all going to work every day. We're all going to council meetings. We've taken up Zoom technology, as has everyone, and working around it. So some things take a little longer than I'd like them to. But other than that, I haven't really seen any impact from COVID, which really shocks me. If you'd asked me that in March, I would have been all doom and gloom.
Yeah, I can attest to on the practical level of working with Franklin in particular, that you guys have done a good job adapting to that, and, you know, in different projects and different things that I had run through the city that, again, everyone kind of learning on the fly. Ira.
Yeah, you talk about learning. Did you ever hear the term social distancing before 2020? Did you know what that was? You know, a Zoom call. We were, you know, basically working off of Teams. This is all the things that have come out of 2020. Coming into 2020, we were looking and, you know, poised for a large year across all of the various asset classes and renovations that we were signed up for. And so it gave us some breathing room to focus on the second half of 2020, which in March became a more urgent situation. But, you know, to Burton's point, projects that are in process, they're going. And there is something to be said about being an essential business when your multifamily asset, your office building asset, your cannabis asset is under construction. It has to go. And inspections have to happen. So, you know, COVID protocols were people inspectorless inspections, going to municipal inspections, taking photos and sending them. That was a change in a COVID protocol in order for us to get some of our municipal inspections passed, because no one was coming to project sites. Obviously, the entire PPE launch, the entire safety in the workplace at the project launch, for managing the trade partners and managing all of the interplay within a renovation of an existing asset, which is not oftentimes uninhabited. So even though there was greatly reduced populations in the occupied spaces, COVID protocols require a tremendous amount of PPE, and we've been in masks, and, you know, we've been working all throughout. You know, right now, I would say we are in the busiest bid effort across a variety of different asset classes, as money is on the sidelines and people are lining their ducks up for, you know, when things are easing. Certain things had to go because some scope pivoted, but the surgical strike of doing this area of the building, which is either we're signed up for a rent improvement and we have to do it, or the building is compromised and we have to do it. Those things have become very intentional. But right now we're looking at retail, big box, multifamily, nonprofit, municipal, across, you know, a variety of different markets. And I'm expecting that the pipeline for 21 is going to loosen. So we're very optimistic about continuing. If you're good, you're working. My trade partners have never been busier, you know, electricians and masons and all of them. Everyone is very, very busy. The supply chain impact of getting product has impacted the project flow. So scheduling and 3-week look aheads have become incredibly important, so we can set expectation properly for our clients and our teams. So, you know, that's a little bit about the 2020 story of Mosaic Construction and COVID's impact.
Yeah. You know, so COVID it's kind of impacted different industries. Obviously, retail and hospitality have been hit hard. Industrial seems to be doing pretty well. Office is in sort of a, you know, in between spot, and apartment buildings, I think, are maybe having a little bit of issues as well. Ira, what investments are you seeing landlords make in their buildings to increase leasing or to account for those?
So let's stay away from, like, you know, a 30-story building, just to, you know, level set a suburban office building or a multifamily community like in Franklin is Whitnall Point. And so that has been going under construction for several months now, and that is all about the exterior. So for me, things that are the most important is the building envelope. You know, from roofing to water management to windows and doors for thermal efficiency, for aesthetic, because there is a certain drive around keeping your asset performing, that it looks good from the outside. And so those are areas that we continue to see. We have active projects in exterior renovation within a multifamily asset. We've done a lot of lobby reno where there is just, in need of a smaller, when there's not a lot of traffic in the lobby of an office building is a great time to renovate the lobby in an office building. And so taking out, 70s and 80s and 90s finishes and putting in color and LED lighting and providing a welcome. So those are lower cost, very finite projects, typically design build. And as Burton can speak to, projects have long gestation periods. So, something that's quick, like a window replacement, if you could get the windows in a timely fashion. But when you're talking about design build, you've got all kinds of finishes that could be impacted by the supply chain delays from COVID, sourcing from different spaces. As Burton was saying, we've pivoted on that to find new and different, because our same old are not able to deliver based on the COVID impact. So that's a little bit more information on how we come about looking at a building. Certainly at the very top of the list is if there's any compromise to anything, life safety, weather, structure, those are things that have immediate attention.
And Ira, I guess I would have one question for you is, we don't do work in Chicago, right? Or really any big coastal city either. I'm just curious, for Rick's question on what work has been done because of COVID as well, if it's been different in Milwaukee compared to some of these other big cities, because it seems like in Milwaukee, even downtown versus suburbs is different in people's perspective of getting into an office space specifically. And seems like people are more comfortable if they have local roots and they're more locally owned, regionally owned, compared to if they're coastal, where their corporate office is maybe in a high rise at on the 25th floor, and the folks making decisions on how people should work across the country are coming from those bigger metros than a smaller metro like Milwaukee or suburban of Milwaukee. So I don't know if you had any kind of tidbits from examples of what work you've seen done in Milwaukee versus Chicago or other markets.
As big as Chicago is, and Milwaukee comparatively, is in a different sect, a different size, they're remarkably similar, and maybe it's just the lakefront that clouds my vision, but when you're, looking at what things look like, the novel example that I spoke of earlier is a good example. They have small offices for teams of larger companies that they are so team focused that they work with 10 people on the team. They set them up in a small office and they deploy them into not the corporate headquarters, but into a space where regionally they're coming together. Now, COVID has impacted that and slowed that down. But I do think that is a solution for larger companies from the coasts to mid-major markets to suburban markets, where there is the possibility for communal work in team settings, smaller, and then the technology has to be there. Technology is really the self-leveler. I mean, we're all 5 of us on the screen that I'm seeing, plus all the listeners, we're all in different areas. And yet here we are having, a 3-hour intentional workflow meeting. It's amazing that, certain types of business in an office setting have to be together, and technology allows for geography to matter less.
Callie,
be good for Milwaukee.
Yeah. So Callie, have you, Franklin's pretty uniquely positioned. It's but obviously closer, just outside of Milwaukee, but, on that corridor towards Chicago. It's, land is cheaper, taxes are lower than the big cities or bigger cities. Have you seen any of that? We've all heard, and as Burton and I talked about the coastal cities in particular, those companies that are been in high rises and have been in those very dense cities looking for opportunities to move to an area where those costs are lower, people can have more space, and we can, take advantage of the technology. Have you seen any of that?
So we have a perception problem. People seem to think Franklin is way south, right? The city's 6 square miles. So the southwest corner of Franklin is 6+ miles from Milwaukee. But the northeast corner of Franklin touches the southwest corner of the city of Milwaukee.
Right.
So we are literally right there. You can go from Ballpark Commons and be downtown in less than 15 minutes. So part of what I'm trying to do is focus our marketing on here's where we're at. Because I think that when people know where we're at, the rest of it's going to sell itself. All of the things you talked about, Rick, you know, the lower cost, the lower density, 33% of the city of Franklin is available for development. So we have all the opportunity. It's just a matter of changing those perceptions in Southeast Wisconsin.
All right. So Burton, why don't we throw this next one to you? So how has the current economy affected fundraising and financing for major projects? Is the makeup of the funding sources shifting as a result? For example, are there fewer commercial loans and more private funding, stuff like that?
Yeah, I guess like everything, it depends on the sponsor, and it also depends on what project it is. So even for us, you know, a well-located and well-studied, you know, apartment or industrial project, we're going to get equity and debt on that side of it, or we should be able to, from what we've experienced in the assets that we're looking to do. The challenge will be the banks. You know, their portfolio protection right now is, maybe some of the listeners can probably attest, is, you know, they're a little bit in portfolio protection mode until there's a little bit more certainty there. And so it's going to be, you know, for the most part, you know, a well-capitalized sponsor, and, you know, an asset class like industrial, like multifamily, that, you know, it has the demographics and has, you know, some of the metrics behind it that should make it successful for years to come, even during COVID. And that they're fairly adaptable as well. And you can pivot, you know, with an industrial building or multifamily building, you know, should you have kind of a change of the economy, with the tenants that are there, fairly easily compared to an office building where you're putting in substantial, you know, 50, 60, 70 bucks a square foot from a landlord side. And, you know, there's significant risk for the landlord and for the, you know, investors and the lender, if that's not underwrote correctly. So there's still definitely capital out there for equity and debt. It's a little bit more challenging to come by. At the same time, you know, I think there's a huge appetite to be able to find good deals. And so I think as long as it's a you know, whatever you consider a good deal, there's going to be plenty of opportunity there for you.
Ira, how about you? Have you seen any changes or any more difficulty to finance projects?
So we are typically downstream of that. Our role in, you know, helping them get their money is in preliminary budgeting, you know, and coming up with some type of pro forma, so they have an idea, again, on a renovation, you know, what's involved based on what their need is, their time frame. So, you know, we're involved in it, but in terms of the securing of the financing, I'm just very fortunate to have strong relationships with clients who are, you know, in some annuitized positions because they own assets amongst the sector or across asset classes, and they're well funded. You know, a lot of it is private, a lot of it is leveraging existing relationships. But to Burton's point, the site is one of the key first. You know, when you identify where you're going, you have the banks seem to like real estate based on the principle of location, location, location. And so if you are fortunate enough to find your opportunities in locations that drive positive revenue on the pro forma, and you have a history with the lending institution, and you have a track record for performing well on the assets, we're getting paid. That's all I can say. So there's you know, there's financing in place for the projects that you know, we're working on.
It's good to hear. Callie, you know, we had talked a little bit earlier about some of the moving of TIP dollars to different districts that you've done to buy some time during this period, you noticed any competition for TIF funds? Some of the kind of municipal, I know, like in the tax credit sphere, is that, have you seen anything like that in terms of just not only what's happening in Franklin, but sort of competition for TIF funds in surrounding communities?
So I just got a call this morning from a broker who is looking for a build-to-suit 50,000 square feet. They've identified a location in our industrial park. And of course, the question comes up, what can the city do for me? And outside of tax increment financing, we really don't have anything. Our demographics don't make us eligible for CDBG or opportunity zones. So we customize all of our projects. So when I get to learn a little bit more about what his client's needs might be, maybe we can provide some kind of gap that isn't financial, or maybe there is a financial gap that we could assist with. It's too soon to say, but we also then pull in our partners at the WEDC, the Wisconsin Economic Development Corporation, for tax credits on bigger projects that have significant investment and job creation. But I am really seeing that the developers that I have been working with, if we can have the public infrastructure in place, they'll take the risk and they'll spend the money to construct their facilities. And so I haven't seen that high demand for grant incentives for developers, extraordinary development costs, or anything like that. And I think we've just been lucky so far, or we've just done some really good planning and are ensuring that we're putting our public infrastructure dollars in the places that make the most sense for developers. Smaller projects, yeah, I think we've probably lost some because we don't have any real significant, meaningful tools to assist companies. But I think that's more our demographics than an indication of policy in Franklin.
Well, like any economic downturn, there's going to be distressed real estate opportunities. What should Milwaukee investors look at specifically to make sure they get a diamond in the rough as opposed to getting caught in the money pit? Burton, you want to jump on that one first?
Yeah, sure. It's a complicated one, right?
Yes, it is.
A building.
That's why I said you start.
Yeah, I mean, a building that you're buying at $15 a square foot could be a horrible deal, right? Even though price per pound, it might seem like a home run. It might eat you alive. So versus something you're buying at $100 a square foot. So, I guess what we do is we break it down into a component no matter what. And, when you're buying an existing asset, is there cash flow first and foremost to help you with that carry, or is it an investment, with a value add component to it? And so you have some of that cash flow. If it's a completely vacant building, then you really have to study as to, how are the windows, how's the HVAC, how's electrical, how's the site, how's the environmental, and those really add up on a redevelopment compared to a greenfield site like you might find in Franklin with public infrastructure there. So I guess that would be my thought, and how I look at it is really breaking down into the component, those components, and if there's anything depreciated from those components that you're going to have to put dollars back into in year 1 or year 5. And do you have the capital to do that in year 5? If all the HVAC's going out, how are you going to underwrite that? How are you going to put that cash in? Is that coming out of equity, or is that coming out of a future bank debt? And will that bank provide that? So I didn't really answer the question, but that's how I would look at it.
Right. Well, do you think, and this is probably maybe also a difficult question, but it's the economic downturn that we are currently in, and that is affecting industries differently, seems to me different than previous downturns. And so it's interesting how, there's how much the idea that a vaccine is coming and that things will get back to normal eventually, and that we'll have this V-shaped recovery, and if will actually come to fruition. And I think that's part of finding those investment opportunities with specific, is going to obviously depend on how much you're willing to bet on a quick turnaround. And so those,
Yeah, and I guess the other thing I'd add is, if you're looking from an investment opportunity, the cap rates have really been fairly unchanged on the ones that we talked about earlier of industrial and multifamily. And, there's still multiple bids a lot of the times on those types of assets. The ones that really haven't seen as much trade to understand where the cap rates are going are, besides the massive one that just sold, I think in New York for almost $1 billion, you haven't seen many of the, office buildings or retail buildings trade during COVID to see where they come in at.
Ira, where are you seeing opportunities? Or are you putting your money on the sideline?
Well, you talk about distressed assets. Those are opportunities. That's where we excel, because more than, in my experience, renovation is more challenging than new development because you have existing systems to tie in. You're typically value adding, repurposing, in some cases, completely redesigning the asset to repurpose it. And so you have to know your strategy for what is the purpose of the asset while you own it, because that's going to level set where the spend is going to go. And that's going to help me as a collaborative design build partner understand what we have to pay attention to, because I'm on the side of the owner. I want to protect the asset. I'm not looking for it to be a money pit. If they are over investing, if we didn't do a good job in a needs assessment up front, providing what can stay, what is past useful life, what's the transformative element of the asset makeover, those are all part of before you ever swing a hammer, those answers have to be known. And so as a design build collaborator and pulling out of our clients in various asset classes, what it is they're trying to do and where our expertise as a general contractor can help them understand better some of the limitations or opportunities within an existing asset. I think that there is the value add market is a great place for opportunity to, for an investor owner to make money, ROI, across mostly commercial real estate and multifamily. That's where I would be looking for diamonds in the rough, despite competition and multi-bid opportunities as you're buying things.
So Burton, in your role as president of investment and acquisitions at Weingartz, you review, real estate opportunities, not just in Wisconsin, but in surrounding states in the country. Going forward, do you see Milwaukee as having any kind of inherent advantages compared to, comparable cities in the Midwest or the nation?
Yeah, I think we have a great, I do. I think Milwaukee is well poised for the future. I'm going to say Metro Milwaukee, right? Not purely just city of Milwaukee. City of Milwaukee has its own challenges, frankly. But Metro Milwaukee in Southeast Wisconsin, I think, is well poised. I think we have a great business climate. I think we have great cost of living. And so, there was just an article, I think last week that basically said, 25 million people are planning on relocating somewhere in the US. And a lot of that, I think it's 20% from large metros are planning on moving out, when traditionally it's about 3.6% of the population moves each year. So where do those people go? What are those migration patterns? That's what you really have to study. And obviously, the Sun Belt has, been able to have a lot of the benefit of that migration pattern versus, the Snow Belt that we're in. But could that change? I think it could, because we have a great, we don't have necessarily the natural disasters, unless you call it blizzard a natural disaster. That's about it. And so I think we have a big opportunity to bring more tech jobs. And I think if we really become known in Southeast Wisconsin for having more tech with MSOE, Marquette, University of Wisconsin-Madison, we have great university systems in Southeast Wisconsin. If we're able to really capitalize on that and, kind of tell the story to the rest of the country and to some of these larger companies who are now working from remote, we have a huge opportunity to kind of bring that true migration pattern that we really haven't been able to do in Southeast Wisconsin historically. And that's ultimately going to help create the jobs and create the income and, help out on the racial wealth gap that there currently is.
Callie, what about you? What do you think are the advantages of the Milwaukee area, Southeast Wisconsin?
So before I answer that question, I will just share with all of you that outside of the industrial and commercial that we're in general talking about today, in the last several months, we have had 4 restaurants open. They're all doing very well. We have a Big B coffee shop coming. They're a huge Michigan-based coffee brand. We have Habitat for Humanity Restore coming. We have 3 daycares. One is already constructed, one's under construction, one's coming. We've got UW Credit Union under construction. We have Tires Plus under construction. Copart is coming to our Loomis Business Park in the southwest corner of the city. And as you've all read, in addition to Strauss Brands, who is a homegrown company, Karma has also publicly announced that they are staying in Franklin, and I can't talk any more about it than that. But to me, based on what I've just shared with you about 2 of our big companies that both have name brand recognition, the diamond in the rough is to make sure that our existing businesses have everything that they need to be successful and to try to leverage what they're doing to either help them expand or to bring other businesses that are on their supply chain, perhaps, over into Franklin. I think our proximity to downtown Milwaukee, our being on the I-94 corridor between downtown Milwaukee and Foxconn and then Chicago is a huge plus for us. And I think that in the earlier panel, one of the speakers had mentioned that the travel times to suburban areas where the sites are is a huge challenge for developers. And so I think, again, our proximity is really going to help us in that regard. Along with, because of COVID, everyone's finally understanding that many things can be done remotely. You can live wherever you want to live. And as long as you have a good internet connection, you'll be able to succeed in your career. So there's an opportunity here for us. And we are in the middle of looking at how do we get smart about laying fiber and broadband throughout Franklin so that we can tell a small business or an individual who wants to live in Franklin and work remotely that this is the right place for them. And to that point, when they reconstructed I-94 for Foxconn, I was told that they buried dark fiber. So I have this vision. This is my diamond in the rough, right? We've got over 500 acres right off I-94 and the Elm Road interchange. I would love to see it be a smart park. I would love to go after those tier 2 and tier 3 suppliers to Foxconn, the widget makers, the chip makers, the harness makers, all of those different companies that might be involved one day in the production of autonomous cars. So I see a huge opportunity for Franklin, both with proximity, with high-speed internet and technology, and based on what I'm seeing in development that is really kind of happening in a very native and natural way. There hasn't really been any attraction to make all of these things happen. I think that the city itself is a diamond in the rough, and I really expect this to continue in the next several years.
Ira, what about you? What do you see as Milwaukee's advantages? Milwaukee area?
So I'm a transplant happily in Pleasant Prairie. And I feel like I've landed in the best place that I've ever lived, even though I'm, a business in the Midwest and specifically in the Chicago market. There are so many people like me. I'm actually a statistic where I have come, migration, leaving a state to go to a state. There's migration to Wisconsin. and it's a destination. And Southeast Wisconsin specifically, in my world of what I do, is the crown jewel in all the various, if you break the state up into quadrants, the Southeast quadrant is absolutely the star performer. And there's so much, Callie just spoke about it. Burton is in development, upstream of me in a different sector than me, but, is investing, and, industry is coming. I will say this, not to raise anything political, but at some point, cannabis is going to go nationwide. And when it does, there's going to be, that sector coming into the state. I can just tell you in Illinois, where we started in it 5 years ago, it has been a game changer for the state for a lot of things. And it's seemingly that way in the states we're working in. And so whenever that happens, that's a yet to come, and that's going to be transformative. And Milwaukee is a destination for, that as well. So I really do think that I'm very bullish. I'm spending more time in the Milwaukee area than I am, looking at projects in the Chicago market. And of course, contracting is about relationships. And so we're investing heavily in our relationships in Wisconsin. We've been fortunate to align ourselves with some great organizations that have multiple assets, with some great people who are in leadership positions. And I think Milwaukee I'm so glad I discovered, I guess is what I would say, as a kid going to camp in Wisconsin for all of my childhood and coming for the summer. I'm happy to be in, Southeast Wisconsin 12 months a year. I think it's the right place to be at the right time.
Excellent. So how, this is probably a little bit outside of, well, maybe not Callie's, but outside of Burton and Ira's wheelhouse, with how do we get that migration to come to Milwaukee? Like, where does the city and the surrounding municipalities need to invest to get the word out? Is the word out? Is it, Milwaukee?
Yeah, the word's out, Rick. You're not you're not a little secret anymore. You're one of the hottest sub markets in the country, and have been for a while, as far as, from the state line up and through Madison. It has been, I don't think we're telling anything that the listeners and us on the panel aren't aware of. That we're very fortunate. I mean, Callie, your story is awesome. What you just told us 20 minutes ago, that's amazing. How can you say that that's, I didn't know all the details, yet that's an incredible amount of activity and good storyline. So I would say not everything is Franklin, but that's probably indicative of what's going on in the planning stages for a lot of the Southeast Wisconsin municipalities.
Yeah. It's, speaking for myself, I guess I am happy to hear how positive you three feel about, we're in a very challenging and difficult time. A lot of people are hurting for multiple different reasons. But it's very comforting. Maybe that's the wrong word, but it's energetic. It makes me feel energetic to hear all the positive and thoughts and enthusiasm for Milwaukee. We're getting close to 5 minutes too. Is there anything that we haven't touched on that you guys wanted to specifically talk about, or bring across in terms of Milwaukee or Franklin or anything in the area?
I would just, echo again, just based on what we're seeing in project opportunities across all asset classes. And when I say multifamily, it's senior, it's student housing, it's affordable housing, it's Class A housing, it's all reno, but there's projects in all of those, sectors within the multifamily sector that are value add plays or refresh plays. So, I have as a general contractor, I have a much more general view of asset classes. Callie too, she's dealing with new development, but it's across all different types of, classes of real estate. So I'm just really positively focused on good energy, good relationships, transparency. Business today is so much more about transparency and building strong alliances. And I think that is also very Southeast Wisconsin. I think that, the community of people that I commune with in the business and in my personal life, it's nice people. The Midwest flavor exists in Wisconsin, Southeast Wisconsin. And I think that when you come with that as your basis, for the most part, it helps everything, actually.
Yeah.
Mm-hmm. Ira, I'm really pleased to hear you say that from your perspective. Rick, you had asked about what we're doing to try to raise awareness and get new projects and things. And my council approved a $19,000 spend with Site Selection Magazine. And my reasoning was, I can't get out and network in Southeast Wisconsin right now, physically in person with people. So this is giving me an opportunity to maybe take a global stage and try to break through the clutter and tell the story about what's happening here in Southeast Wisconsin. And so we have 5 of the last issue, then the November issue, and then 3 more. So we're doing almost a year of advertising in Site Selection Magazine. And Ira, you've given me a great idea. I can tell the story about not just Franklin, but why Franklin and the framework of what's happening in the greater Milwaukee area. So thank you for that.
You're so welcome. Obviously, conversation is free. We're having, this great conversation with, thought leadership and expertise in the areas that we touch. And, I would just put it out to the listeners that, a phone call is free and outreach is free. If you heard something today that you're interested in that bubbled something up inside, I would avail myself. I'm, very happy to collaborate and, bring my voice to something that, might be in my sphere. So I want to offer that as thanks for having me on the panel.
Well, thanks everybody. We're getting close. Is there anyone, Burton, did you want to jump in, or are you good? Or
No, I just think to add on to Callie's, I think somehow in Metro Milwaukee and Wisconsin, we do need to do a better job of telling the story to the rest of the country, because that's how you're going to truly create change in Wisconsin and have some of the rental rate growth that we need to continue to do projects. Construction pricing is going to increase. We need rental rates to increase as well. And the only way to do that is if you truly have, job growth, wage growth, and then rental rate growth in order to support new development. And strong partners like Franklin and like the other, the public-private partnerships, they're strong in the area and they have to remain strong as well. So that's how I think, we need to do a better job of telling the story of Wisconsin.
Yeah, that's always kind of been a hurdle for Milwaukee in the area to get over with. I think there's a lot of, well, it's cold and, sometimes that kind of Midwestern humility does us wrong. Well, I want to thank you all for your time. This has been a lot of fun for me. I hope the listeners had a good time too, and I appreciate being part of this. Thank you very much.
Thank you.
Fantastic panel number 3. Way to go. This was a great group, great event. I agree with you. Milwaukee, we just got to get the word out more events, and I got to push them out nationally. This event will be on YouTube. I'm going to try to get it done tomorrow morning. I got to add a new header and footer. I'm also going to take clips of y'all speaking. Probably won't get to everybody, but include it in our Monday news show called Power 30 at 11. I'll send you out a link for that too, so watch for that. So y'all might be on the news. We're trying to upgrade ourselves and try to just not be a newspaper company anymore. So join the future. It's kind of fun. Anyway, thanks everybody. Fantastic. Have a great weekend. Get out and enjoy it while it's still not snowy in Milwaukee and Minnesota.
Great.
Bye.
Thank you.
Thanks everyone.
Bye.
Bye.